Stocks taking a breather ahead of a potentially breathless week. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. And it's an exciting week, a lot to look forward to. Not so much if you take a look at equity markets right now. You have the S&P 500 pretty much unchanged on the day, trying to fight its way back into the green. You can see that big tech already got there. The Nasdaq 100 up about 0.2%, but pretty small moves. Meanwhile, you take a look at that bond rally reigniting. The 10-year Treasury yield down to 4.40, down 6 basis points on the day. We'll see how low it can go. Same thing, too, for the VIX. Of course, we've been watching this one, seeing how low it can go. Right now, it's below 13, currently trading with a 12 handle, Romaine.
Yeah, the main U.S. equities right now, at least the average indices right now, not doing a whole lot here on the day, but it is actually a relatively good day for some of the apparel and retail stocks after the early holiday shopping numbers showed a consumer that is still willing to spend. Adobe tracking the data and estimating online sales alone rose from last year to about $12.4 billion on Cyber Monday and to $9.8 billion for Black Friday. You can actually thank flexible spending options. That includes those buy now, pay later features that have really helped a lot of shoppers stretch their budgets. And that's one reason why the big Black Friday related stock market winners don't actually sell any retail products, but they do help finance them. Affirm surging as much as 16% today to a fresh 52-week high. Square and PayPal also getting strong bids here on this Monday afternoon. It's also potentially going to be a big week for cybersecurity and enterprise software stocks. Zscaler set to report after the bell tonight. Analysts at Guggenheim expecting the company could raise its full-year outlook, and our team over at Bloomberg Intelligence sees billings growth holding at a rate of 30%. Competitors CrowdStrike and Splunk set to report tomorrow. Okta releases on Wednesday. Also in the mix this week, a broader array of software providers, including Salesforce, Workday, Intuit, Snowflake, and Hewlett-Packard Enterprise. And it could also be a relatively big week for economic data. Housing, manufacturing, and inflation reports being teed up over the next few days. And the folks at Bloomberg Economics, Katie, say the market right now is priced too much for a perfect landing, dismissing some of the signs of potential economic downturn. Yeah, plenty of green shoots priced in, not just in the U.S. equity markets, but globally as well. You take a look at global stocks here as measured by the MSCI World Index. You can see that we closed out on a 4th straight week of gains. That we haven't seen a streak like that since going back all the way to last summer. So again, not just a U.S. story, but a global story about some of that gloom maybe getting priced out, maybe some excitement getting priced in. You take a look at the bond market, meanwhile, talking about an equity rally. Let's talk about the bond rally that we've seen. We know that your bond portfolio had been sitting on some pretty big losses. We had been sitting on gains when we go back to the spring, to the summer, and then things got really ugly in autumn. But now actually your portfolio is back to positive territory on the year, just slightly, but still there. So Romaine, really, it seems like sentiment is shifting across every asset class. Yeah, it'll be interesting to see how the economics stacks up, particularly when we talk about the divergences that we're seeing between the U.S. economy and the rest of the world. Jeffrey Kleintop joining us right now to help kick things off to the close, Chief Global Investment Strategist over at Charles Schwab. Happy Cyber Monday, and hope you had a good Thanksgiving. Jeffrey, let's get right to it here. I do want to start off first with the U.S. side of the economic picture, an economic picture that, at least based on the data we've gotten so far, as well as some of the early results out of the Black Friday, Cyber Monday shopping season, we're still a relatively strong economy here.
Yeah, I guess if I had to nitpick, I'd say maybe some of the high-end luxury retailers weren't doing as well. And we heard, I think, on Tuesday of last week from Home Depot and Kohl's that Home Depot and Lowe's, that we weren't seeing maybe appliance purchases, more high-end purchases as people were coming into the stores. And I think I mentioned Kohl's. What we heard from Kohl's was maybe Sephora partnership brought more people into the stores. They didn't necessarily spend more. So I think overall a good season, but maybe a little less at the high end. Maybe those purchases that we usually finance on credit cards or by other means showed a little bit of weakness there, perhaps due to the higher interest rates. So maybe that'd be where I may find a little bit of maybe a point to pick a little bit, but overall a pretty good shopping season for a period of time where the economy has been a little bit softer around the world.
And of course, we have a market that really is trying to see if the Fed can stick that soft landing, and I guess time will only tell. But it's kind of interesting, too, Jeffrey. We heard from Christine Lagarde, head of the ECB. She also seemed to be addressing the issue of a softening labor market over in Europe, though she did point out here, of course, that some of the spending trends over there aren't nearly as strong as they are here in the U.S.
Yeah, that's right. We have heard from Germany, for example. We've seen many months in a row of a cooling labor market. In fact, unemployment in Germany rose by 30,000 in October, pushing the unemployment rate up to 5.8%, the highest level in more than 2 years. The PMI employment component has really been pointing to a dive in employment in Europe. And so a little bit of a concern there about the labor picture might compel the ECB to begin to cut rates in the first half of next year. We're going to get the inflation reading on Thursday for Europe, likely coming in at 2.6%, very close to that 2% ECB target, giving them the freedom to consider that as soon as the next 6 months or so, they could begin to cut.
And what do you think that this means for the Fed? Because, okay, maybe you see things in Europe go a little bit haywire. Maybe we start to talk about the potential for a recession over there. You take a look at the U.S. and as we were just walking through, people have been so eager to price in that soft landing. If we do see a divergence when it comes to the U.S. and Europe's economy overall, how would you expect the central bank in the U.S. to react?
Well, I think one of the concerns is, right, we don't want a lot of strength right now. So the resilience in the labor market, the resilience in consumer spending that we're seeing here maybe prolongs the period that the Fed is on hold. We don't see another hike from the Fed. I think it's only maybe a 1% chance priced into the December meeting, but maybe that means they're not as quick to cut rates next year. Maybe it isn't pushed till the end of next year. They really feel like they have the clarity and the ability to begin to cut rates. And that could really change things around a little bit as we look at where we're going to find stimulus in the world. So weaker economy right now in Europe could mean an earlier return of stimulus, both monetary and fiscal policy, next year in Europe, and that could benefit stocks over there, which are priced at a steep discount to their 10-year average.
And sticking with this global theme, let's also talk a little bit about China, because, of course, the China recovery story had been one of the big themes of 2023 that went bust. You take a look at their stock market, one of the worst performers on a global basis. Do you think that 2024 will be any different?
I think it could be a little bit different. I think it's probably a better year, although I don't know if it's going to be a great year. There's still a lot of issues that China's got to work through. We know it's a political year here in the U.S., and we know China will be top of those issues, and not in a friendly way when it comes to those campaigns. But we are seeing more effective measures being put in place to slow down the decline in housing activity that started to show some signs of recovery. And we know that's the core of the weakness in households there. If households do believe they're going to get those houses delivered eventually, or maybe even get their down payments back, that would change their spending picture entirely. They do have ample savings to spend. They're just worried those savings have been lost to developers that are going to go out of business. So I think we're starting to see that confidence begin to return in China, maybe heading for a better first quarter in China than maybe many expect.
All right, Jeff, always great to talk to you. Jeffrey Kleintop there, helping us kick off to the close.
Thanks for having me.
Here on this Monday afternoon, Chief Global Investment Strategist at Charles Schwab. Coming up after the break, a closer look at U.S. consumers out and about trying to shop and some of the frustrations that they're finding when it comes to inflation and the economy and what it could mean for the election next year.
Plus, U.S. sales of new houses, they fell in October. We're going to discuss what it means for the economy with Daryl Fairweather, chief economist over at Redfin.
And in our Wall Street Week Daily segment, a closer look at the outlook for crypto regulation. Tim Massad, former chair of the Commodity Futures Trading Commission, is going to be stopping by the big program in just a bit. All that and more coming up here on The Close. This is Bloomberg.
Well, after years of inflation, U.S. consumers are shouldering a financial burden unlike anything seen in decades. So just how bad is the U.S. cost of living squeeze? Bloomberg Economics and Business Week teamed up to crunch the numbers. Reed Pickert joins us now for a breakdown. And Reed, it seems like the takeaway here is $119 versus $100. Take us through it.
Yes, absolutely. So, economists tend to focus on year-over-year inflation or month-over-month inflation. But when you talk to actual people, what they're focused on is prices and how those prices have changed over time. And so we wanted to do a story that showed how prices have changed since before the pandemic to now. And it's by a lot. So, whether that's things such as groceries being up 25% since January 2020 or car insurance being up 33%, you see these numbers that are really big to show this cumulative impact.
Yeah.
And while you've seen wages rise a ton, and that's important to note here because that wage growth is really key to the resilience of the consumer that we've been seeing. When you pull back the lens, if you compare to where we were before the pandemic started, wages are, less than 1% once you adjust for inflation compared to the 20% they're up on a nominal basis. So, consumers are looking around and inflation has taken a lot of the wind out of these historic pay raises they've gotten, which is, really fueling some of this frustration that consumers have with the economy.
And I can understand the frustration. And one thing I thought that was really good about the article, you focus a lot on kind of some of the everyday expenses, where we kind of gloss over. We kind of focus on the big ticket stuff, and we forget that just the basics of heating and cooling your home and paying your water bill and everything like that has also gone up. You also sort of tapped into the frustration of renters who are would-be home owners or home buyers, but I basically find this roadblock right now where not only can they not afford a home to buy, but their rent is now getting to the point where it's unaffordable to rent.
Exactly. It's, home values are up over 40% compared to January 2020. And mortgage rates are, much, much higher than they were. So it's not only that you're paying higher in rent, it's also like you're looking back and realizing how much wealth you missed out on if you weren't able to buy a home before this surge in prices. So it's the double whammy of feeling like, wow, I missed out on this big moment, as well as a huge chunk of my income is now going to paying more and more for having a roof over my head, in addition to the other things of paying bills and necessities of everything from, groceries to electricity, as you said.
All right, thanks there to Reed Pickard, Bloomberg U.S. economy reporter, and moving on to help lead our Fed coverage here at Bloomberg. Let's continue, though, with this conversation, particularly about some of the frustrations with the housing market. U.S. new home sales falling in October, down by about 5.6%. But will we start to see a turnaround with mortgage rates now finally starting to back down a bit this month? Daryl Fairweather is joining us now. She's the chief economist over at Redfin. And Daryl, I do want to start off here with some of the, I guess, kind of catch-22 that a lot of folks have. Those folks who are renting but want to buy, at least in certain markets, they can't really afford to buy, yet they're looking at their rental costs continuing to go up. And I'm wondering as to where we sort of see a breaking point where either the rents give in or home prices give in, or is that just wishful thinking?
In most parts of the country, it is more affordable to rent than it is to buy a home with a mortgage on a monthly basis. And that's probably going to be true into next year, which is one reason why we're expecting home demand to continue to be soft. Now, if rates were to fall, that math could change and we could see more people deciding to give up renting to enter into the housing market. But if that happens and there is more demand, there would be more competition and higher prices. So it's hard to get out of the place we're in where housing is just generally unaffordable.
I think it was interesting, too, some of the data that Redfin, your folks over at Redfin put out, really talked about the mobility that we're starting to see, at least for those who have the ability to move to lower cost regions in order to buy a home, that we've actually seen that number of people, that percentage of people really start to tick up.
Yes. So even though fewer people are moving, the people who are moving are increasingly moving out of their metro area. So people leaving San Francisco and, say, going to Sacramento or even Fresno or Bakersfield, people are chasing these markets that are still affordable. Now, there were some markets that used to be affordable that got quite expensive and they've had a correction, such as Boise and Austin. But the trend continues to be people leaving expensive areas and moving to more affordable parts of the country.
And Daryl, it also caught my eye that, of course, as we talk about affordability and we think about these ultra high mortgage rates, this data that you have on people paying all cash, it seems like if you can pay all cash right now, that's what people are increasingly doing.
Cash is always king, and right now it's especially true because if you have cash, you can get around this whole high mortgage rate problem and you're facing less competition. We're seeing people leave expensive areas like California, where they may own $1 million home, maybe half of it is paid off, and then they can go take that $500,000 and buy a home all cash in a place like Arizona or Florida. So if you have that ability, if you have equity, it is still a good time to buy.
And Daryl, what sense of do you have when it comes to pent-up demand? That's what I have always been wondering about, because you think about the people that Romaine described that are renting right now that would like to buy, waiting on the sidelines. What's the temperature there?
Anytime we see a movement in rates, people get off the sidelines and decide to buy. So if rates were to fall, a lot of people would decide that instead of renting next year, they're going to make the jump into buying a home. People want to buy homes, it's just a matter of them being unaffordable. So anytime affordability improves even the slightest bit, we see more people deciding to buy a home.
How much of this is actually, I guess, hard calculus, and how much of it is just kind of, kind of the gut psychology that certain potential home buyers have when they see sort of the interest rate tick down, even if it's just a fraction of a percent?
For people who are currently in the market to buy a home, those little changes in mortgage rates make a big difference. It can be the difference between them saying, I'm going to wait and not make an offer versus now is the right time and I'm going to jump in. But for people who have been renting a long time and these rates have gotten so high and far out of reach, it doesn't matter so much to them. They're probably more thinking about what is the lifestyle difference between owning a home versus renting? Can I get more bedrooms? Can I move somewhere where for sale homes are more common? Those are more the considerations that go into buying a home.
All right, Daryl, really enjoyed this conversation. Great to check in with you. That is Daryl Fairweather. She is Redfin's chief economist. And it's an interesting conversation. I mean, people just chasing affordability. In some cases, that means actually moving. In some cases, that means just renting. In others, it means let's just buy all cash.
Yeah, and I really found the mobility thing interesting because I feel like it was kind of, you saw this in the 70s and the 80s where people started to shuffle around the country looking for a more affordable opportunities. And that really did change the landscape of the cities that did well over the next couple decades as well as the cities that didn't do well. And I do wonder if we're kind of on the precipice of that whole trend playing out once again. I feel like it already has, given all the folks that have moved to places like Texas and Florida and just kind of those Sun Belt states.
Then you think about some of the other costs involved, though. In some cases, I need to find a new job. I need to uproot my children from their schools. A lot of different factors there. But coming up, we're going to talk
we didn't ask you, though. But the top places that people are moving, Sacramento, Las Vegas, and Orlando.
Yeah.
Which one?
I would.
Yeah, you'll only have three choices, Katie Greifeld.
Let's go Sacramento. Why not?
Okay. It's an interesting flex, but okay.
Left you speechless. In any case, coming up, we're going to talk all things holiday shopping. We're going to do that with Barry McCarthy.
Sacramento's lovely.
CEO of the payments company Deluxe. That conversation coming up next. This is The Close on Bloomberg.
Focus on the consumer on this Cyber Monday and a focus on the health of small businesses. You know the company Deluxe, probably for its checks back in the day, but it's pivoted in a big way, focusing much more on payments and data, and that data is telling us a lot about consumer trends. Barry McCarthy is the CEO of Deluxe, and he joins us right now. He's also the author of the book, Small Business Revolution, How Owners and Entrepreneurs Can Succeed. Barry, great to have you here on the program, and I don't just say that because all the best and brightest people come out of Chicago, but nevertheless, here you are. We talk and we round out once again with a new connection. And let's start off here with kind of what you are seeing so far. I know the sort of holiday shopping season is still somewhat nascent, if you will, but what type of trends have you been seeing, particularly when it comes to the demographic spending trends?
First of all, it's great to be with you today. But we continue to see healthy consumer spending. But we definitely can see a shift towards less discretionary categories. So discretionary categories are a bit under pressure. Through the Thanksgiving holiday period, we saw strong average ticket size and an increase in the number of transactions overall, which would seem to suggest that the consumer remains healthy. But the shift in the mix of things that they're buying might seem to indicate there's still a bit of pressure on consumers with a more focus on less discretionary categories at the expense of discretionary categories.
Yeah, it is an interesting trend, and I do wonder, like when we make so much hay about the total amount of money spent and whether it was higher than than the previous year, does it matter if those things being purchased aren't necessarily those kind of discretionary items like, the jewelry and other things that we would normally gift, and they're just more basic goods that we probably would have bought anyway at some point in the future?
Well, it does have an impact on the economy overall because it particularly gets focused then on the less discretionary categories are places where it helps the economy grow. Consumers can only eat so much food. They only have so much power they can consume. There's only so much insurance they can buy. So it can have a bit of a dampening effect if consumer spending slows. But I want to be really clear. We are not seeing a wholesale slowdown. We just see some softness on the discretionary side of the equation.
And Barry, when we think about some of these trends, especially the shift to online, it seems like a lot of the data coming out of Black Friday and what we've seen so far for Cyber Monday is also a shift to buy now, pay later, those sorts of strategies becoming more popular. What are you seeing on that front?
Absolutely. Alternate payment types, including the buy now, pay later opportunities, continue to gain traction with consumers for a number of reasons. Simplicity, but also in the case of buy now, pay later, consumers are signaling that they would like to do exactly the name of that solution, buy now and pay for it later, which also may indicate a little bit of consumer stress.
And I mean, not to be too pessimistic, but the pay later, does that always happen?
Well, our company does not deliver, we're not a buy now, pay later company. We facilitate all the different payment types, whether it's credit cards, debit cards, buy now, pay later, Apple Pay. Our company helps facilitate those transactions for millions of small to mid-sized businesses. I think that we do see in the marketplace broadly a tightening of consumers as they're returning to the same level of credit balances they had before the recession, which again I think might be a signal about a little bit about consumer softness.
All right, Barry, going to have to leave it there. Great to catch up with you. Barry McCarthy there is the CEO of Deluxe. And it's interesting. I'm glad you asked that question, Katie, about the pay later aspect of it, because this always gets glossed over. And that was a big part of the reason why we saw a lot of weakness in those stocks, whether it was Klarna or Affirm earlier this year, because there was concern about credit quality as to what they were taking on.
Exactly. Of course, it becomes a riskier proposition when you see interest rates get jacked up and very high inflation. Part of the ways that consumers are dealing with some of those pressures is these BNPL sort of strategies, but you actually do have to pay later. So it's going to be interesting to see how that develops. Yeah, and it's also, too, I mean, we should point out, I mean, we focus on buy now, pay later, but there was some great data coming out of the, I don't know who exactly collected it, but it was the credit card data showing kind of, A, the balances, the interest rates people were paying, and also just the ratio in terms of what their available credit was, and you're really starting to see that go up. So people, the spending that we saw a couple years ago were as much about cash coming out of your bank account or your pocket. This is now about people basically taking out loans in order to finance these purchases, and that has to affect what they buy and how much they buy. Yeah, exactly. I mean, we quibble over what the actual level of household savings is right now, but we know the direction of travel. Of course, it has been dwindling, and that's the situation that we're in right now. All right, we got a lot more to cover here on the show. Keeping an eye on the consumer, keeping an eye on supply chains, and keeping an eye as well on the situation in Israel and Hamas. Pete Buttigieg, the U.S. Transportation Secretary, speaking in the treaty room from the White House. We are expecting to get comments from President Joe Biden momentarily. We'll bring you those comments as soon as they begin. Stick with us. This is Bloomberg. This is the countdown to the close. Looking at the markets right now, a bit of a mixed bag coming off what had been one of the lower volume trading days of the year on the truncated version trading session on Friday. We'll get back to the markets in just a moment, but we do want to go down to the White House where President Biden right now is addressing the nation.
We always talk about the big issues, the big things. But sometimes the big things work or don't work based on whether or not the little things are in place. The mechanics are in place. Secretary Buttigieg, thank you for being here today and help us launch this new Council on Supply Chain Resilience. I grew up in a family like many of you where when grocery prices went up, the price of a gallon of gas went up, there was a conversation at the kitchen table. I mean, literally, not figuratively. Those conversations have been going on at kitchen tables all across America for a while now. The conversation about whether we'd have enough left over at the end of the month for my dad to be able, he used to say, have a little bit of breathing room. Well, this past week, as Americans gathered around their own kitchen tables for Thanksgiving dinner, that was our goal, to give them a little more breathing room. And together, we made progress. From turkey to air travel to tank of gas, costs went down. They went down. Now, to people making a lot of money, that doesn't matter a whole lot because the costs are relatively small compared to wealthy incomes. In fact, as a share of earnings this Thanksgiving, dinner was the 4th cheapest ever on record. I want you all to know that. I look at all the press, look at that. The press is particularly excited about that, I can see. But look, all kidding aside, that's not all. On Thanksgiving 2 years ago, 100 container ships were waiting in to dock in the ports. They were lined up, 100 long out into the ocean. This year, there were less than 10, meaning that today, as folks start their holiday shopping, shelves are stocked, meaning that if major appliances like a stove or a fridge broke down over Thanksgiving, you can replace it faster and 9% cheaper than did 2 years ago. These savings matter to so many families, especially at this time of the year. And they're no accident when it comes down to supply chains. Did you ever think we'd be talking this much about supply chains? No, but I'm serious. It's critical. Everybody's beginning to figure it out. The average person knows what we're talking about when we talk about supply chains. But when the supply chains were disrupted, we knew what trouble we had. Before the pandemic, supply chains weren't something most Americans thought about or talked about. But today, after years of delay in parts and products, everyone knows why supply chains are so important. That's why within my first month in office, I signed an executive order bringing supply chains home to get goods moving again. So it started here. We had the basic product here. Less than a year later, I signed the bipartisan infrastructure law to make a generational investment in every part of our supply chain, from our roads to our bridges to our ports to our airports to our internet. Less than a year after that, I signed the Inflation Reduction Act to grow the industries of the future right here at home, including electric vehicles and clean energy. And the CHIPS Act and the CHIPS and Science Act. How in God's name can you lead the world when you don't lead the world in science and development? To make sure we never experience another shortage of semiconductors. You know, America invented these chips. I know my staff is tired of hearing me say this in my cabinet, but these small computer chips the size of a fingertip, they affect nearly everything in our lives, from cell phones to automobiles, refrigerators. If you don't have them, you don't have those things. But over time, we went down from producing 40% of the world's chips to just doing 10%, but not anymore. All over the country, semiconductor factory companies are investing hundreds of billions, let me say it, hundreds of billions of dollars to bring chip production back home here to the United States. Over the last 3 years, all the leaders around this table, these two tables on my right and left, have also worked to lower costs for American families. From cracking down on foreign-owned ocean shipping companies that had raised their prices as much as 1,000% while racking up enormous profits. Teaming up with truckers to create registered apprenticeship programs and move a record level of cargo around the country. To helping family farmers and family farms access fertilizer they need to grow food so many of us enjoyed in Thanksgiving. Folks, the result, today our supply chains are stronger than ever, with backlogs, bottlenecks, and shipping rates at a 25-year low. We've created 14 million new jobs, including 800,000 manufacturing jobs. And the unemployment rate has stayed below 4%. Below 4% for the longest.
Right now, we're listening to the President of the United States, Joe Biden, speaking at the White House about new supply chain measures that his administration is taking in order to basically strengthen those supply chains to make sure that people can get the goods they want. There's also a national security element into the proposals that the president is making, effectively setting up a council on supply chain resilience. And this will be a cabinet-level department that will actually be used to ensure that our supply chains are sound. You can continue listening to the president's comments if you have a Bloomberg terminal by typing Live Go, and you can hear them there. And of course, if he says anything market moving or material, we will bring you that as soon as we get it. We do want to actually stick on this topic of supply chains, though, particularly as the holiday shopping season gets off. And who better to talk about that with than, well, Amazon. Joining us today from its New Jersey fulfillment center is Beryl Tomei, Amazon's Vice President of Last Mile Delivery and Technology. Beryl, appreciate you joining us here on this Monday afternoon, and kind of interesting to hear the president kind of use the phrase that Hey, did you ever think we would be talking this much about supply chains? I should remind them, I think we've been talking about supply chains now for at least the last 3 or 4 years since the pandemic really sort of brought that awareness to us. Give us a sense as to how prepared Amazon is right now for this holiday shopping season vis-a-vis maybe what we saw back in 2020.
Thanks for having me. We are very excited about the holiday season. We're all about adding value and savings for customers. And today's Cyber Monday, we have millions of deals dropping every 5 minutes through select periods. We're hiring to get ready for the holiday season. We're hiring an additional 250,000 part-time, full-time, seasonal employees across our operations network. And we're using technology and AI to further our preparedness. When customers come in our store, they're able to get personalized recommendations. We use AI in the months leading up to the holiday season to forecast demand so we can be ready and prepared for the holiday season, including...
Well, I'm curious if you could expand on that as to how you sort of use the AI and the other technology to gauge demand, particularly as we know that typically during the holiday season, at least for some of the retailers out there, they have to kind of have all this stuff ordered maybe weeks, if not months in advance. So I assume some of those AI capabilities were deployed, I would assume, some time ago, correct?
That's right. We begin months in advance from our forecast demand planning systems. And even day of, on a daily basis, we're using deep learning and generative AI techniques to forecast demand for over 400 million items in our store so that we can place the right items in the right quantities for our customers to get their items as fast as possible. I'm at a fulfillment center right now in New Jersey. This is one of the locations where we store inventory, and everyone's geared up, ready to go. Folks are excited for the holiday season.
And Beryl, tell us a little bit about, in anticipation of that holiday season, you mentioned that you hired several thousand, 100,000 seasonal workers. How does that compare to past years, though? Because there has been some concern that you haven't seen the same amount of seasonal hiring going on, and maybe that's a bad sign for the labor market overall.
This year, we're hiring over 250,000 part-time, full-time, seasonal employees. And ultimately, we're focused on delivering for our customers. And we want to offer our employees a great experience as well. They're the heart and soul of our operation, and we can't deliver for our customers without them. The other investment that we have in the final mile space is our delivery service partner program that is a big factor in our readiness for the holiday season. These are hands-on entrepreneurs that we partner with to have their own delivery businesses. These are small business owners. We have over 3,500 of them around the world, employing over 279,000 people. And they're a huge part of our holiday story for customers as well.
All right, Beryl, got to leave it there. Our thanks to Beryl Tomei. She is Amazon VP of Last Mile Delivery and Technology. Much more ahead. This is The Close on Bloomberg.
All right, let's get a view from the sell side with our top calls. Big movers on the back of analyst recommendations. And we start off with Okta, a market perform rating at JMP Securities, down from outperform. This in the wake of that security breach last month that has an analyst saying the brand's image as a cybersecurity firm has been significantly degraded. Next up, let's take a look at GE Healthcare, getting its only sell rating today after UBS dropped it to neutral. Overall, the analyst finds its risk reward unbalanced and unappealing. The shares down about 3.5% here on the day. And I should point, it was cut to sell from neutral. And finally, let's take a look at Foot Locker, also getting cut to sell over at Citi, which expects a miss on those third quarter EPS numbers, which are supposed to come out tomorrow morning. Weakness in same-store sales, elevated inventory levels, driving Foot Locker to put too many items up for sale, according to the analyst. Shares down 1% on the day. And those are some of our top calls. They do want to stay in the retail space after Black Friday here on Cyber Monday. Some robust sales figures already coming out, with U.S. shoppers expected to spend up to $12.4 billion online just on this Cyber Monday alone. For more insights, let's get to it with Lorraine Hutchinson, senior retail analyst over at Bank of America. All right, Lorraine, let's start off here with some of the spending numbers because, I mean, there's obviously numbers coming out of everywhere. What we buy online, what we buy in the stores. Overall, are we looking at a holiday shopping season that on a net basis is going to be better than what we saw last year?
Overall, I do think it will be better than what we saw last year. I think the only surprise from the weekend was that many retailers were actually a little bit more promotional year on year. And I say this as a surprise because the inventory this year is in much better shape. You'll remember last year, the supply chain opened up at a time when demand declined. And so we were sitting on a mountain of retail inventories in 2022. This year, they've really cleaned it up. And I think there was an expectation that the promotional cadence would be much less robust than last year. We just didn't find that to be true. We found that many retailers were similarly promotional or even slightly more promotional year on year, as the consumer, which is somewhat strapped by inflation, really needs that deal to entice them to come and spend.
And Lorraine, so inventory levels cleaned up at a lot of these retailers, broadly speaking. Talk to us a little bit about supply chain challenges. Of course, the theme of the day with the White House doubling down on its efforts. Have retailers, broadly speaking, been able to untangle some of those snarls that we saw during the pandemic era?
They certainly have. And I think you'll all remember what President Biden was just speaking about earlier, 2021, you simply could not get product. All the retailers were running out of things. There were a lot of holdups in the ports, and it was a really difficult holiday season. How they changed last year was they ordered a lot more and a lot earlier. The problem is demand stepped down. And so you had this surge of inventory into holiday that they just simply couldn't sell at full price. Fast forward to this holiday season, we're in much better shape. Inventory is aligned with sales levels almost across the board. I would say the one place that we're seeing excess inventory is in athletic, particularly athletic apparel. We still see some signs of excess inventory there, but generally, apparel and footwear is relatively aligned with sales levels.
All right. Well, I guess that's good for the retailers and maybe good for their bottom lines. Not necessarily so good, Lorraine, for those of us who are actually out there hunting for bargains. Great to talk to you. We're going to have to leave it there. Lorraine Hutchinson over at Bank of America. Stick with us. We'll be back on The Close on Bloomberg. Welcome back to The Close. It's time now for our Wall Street Week daily segment with the host of Wall Street Week, David Weston. And David, today we're taking a closer look at what's going on in crypto. And more importantly, whether those big cases against SBF and now CZ over at Binance actually might lead to a more stable crypto environment.
Exactly the question remains. Normally, if you get a $4.3 billion fine and have your CEO headed for jail, it's not good news. But I'm not sure when it comes to Binance. It might not be that bad. But let's ask somebody who knows. Tim Massad, he's former CFTC chairman and research fellow at Harvard Kennedy School of Government. Tim, great to have you back with us. So as I say, it's not normally good news, and I'm sure they would rather not happen. But given where Binance was, is this the only path forward for them?
Well, I think it was. This is a very important settlement, and it will help limit the use of crypto for money laundering and for financing terrorism and other illicit activity. Binance is the largest crypto trading platform, and now they will have to comply with some basic laws about that. But to your point, or to Romaine's question, not at all clear that this is going to improve investor protection overall. I frankly don't think it's likely to change that for U.S. investors. Frankly, it'll probably just make it harder for U.S. investors to use Binance, because what Binance was doing before was actively courting U.S. investors without complying with U.S. laws.
Tim, what if anything does it say more broadly about cryptocurrencies? Because there are those who say the most use case for cryptocurrency is actually doing things that are illegal. And some of the things alleged here are pretty awful, including financing Hamas, goodness sakes.
Well, they are, but I think it's important to remember that from what we know, those transactions still represent a fairly small amount of the overall crypto activity. Now, we don't know that for sure, but I think most of the analysis that's been done on Hamas would say, look, Hamas only gets a very small part of its funding from crypto. And with Binance, you know, even the transactions that were deemed to have occurred between U.S. persons and persons in sanctioned jurisdictions, the Treasury Department acknowledged that these were only a very small part, less than a fraction of a percent of Binance's overall activity. So, the people that look at this and say, see, this shows crypto is only for illicit activity and this means crypto will fade away. I don't think we should conclude that. I think crypto is here to stay, and we still need to improve investor protection.
Does this case, the Binance case, and for that matter, you can throw in the SBF trial as well, does that actually, Joe, change the complexion of how people are going to view crypto? I mean, it may be here to stay, but has that complexion changed?
Well, certainly it does. I mean, I think it wakes people up to the fact that there are problems here. There is the potential for crypto to be used for illicit activity, and there is a lack of investor protection. But what concerns me, Romaine, is still that at least in the U.S., we just don't have a consensus on how to move forward. And so I'm doubtful that we'll see, any basic strengthening of investor protection in terms of changes to our laws prior to the election.
I am curious as to why you think it's taken so long. I mean, particularly when you listen to Gary Gensler at the SEC, who's now 3 years into his job, and obviously the CFTC as well, which in theory would have a role as well. 3 years is a long time, and we still have not gotten a formal proposal as to how they're going to regulate.
Well, the SEC and the CFTC have used their existing authority to bring enforcement cases. And those cases are very important, and I support what they've done. But I don't think it's enough because we have this fragmented regulatory system, and in particular because we don't even have a federal regulator of the spot market for trading in crypto, which is where most of the activity occurs. And so that's what I think Congress still needs to fix, or the SEC and the CFTC have to be more creative, which is what I've suggested in getting together. And I think there are ways that they could do that, but they haven't done it. Now, we are seeing other jurisdictions move forward to enhance their regulation of crypto, and that will certainly help.
One of those jurisdictions, as you know well, Tim, is the state of New York that has moved ahead. Do they give something of a roadmap for the federal government as a way to regulate crypto?
Well, I think they've done some very interesting things on stablecoins, and in some ways, that's a decent model. I think we still need a federal framework, and even the head of the New York Authority, Adrian Harris, will acknowledge that we need federal regulation here, both for stablecoins and for crypto trading platforms and the crypto sector more generally. It's just that right now our Congress seems too divided. Of course, they're divided on lots of things, but in particular on crypto, there just doesn't seem to be a consensus on how to move forward.
Tim, talk about divided on various things, including whether we're going to keep the government going. And then next year, of course, is 2024, a presidential election year. As a practical matter, does this mean we're going to have to wait till after that election? We're going to have to wait till at least 2025 before we really see a comprehensive federal regulation legislation?
I think it's likely. I would say that on stable coins, there's maybe a slightly better chance that we might see some movement there in the creation of a federal framework. And again, I think the SEC and the CFTC could on their own be more creative, get together, articulate some common standards, and try to make these crypto trading platforms abide by those. But thus far, they haven't done that.
Tim, it's always great to have you with us. Thank you so much. Tim Massett, he's former CFTC chairman and research fellow at the Harvard Kennedy School of Government. Romaine.
Yeah, one thing I was interested, though, too, is, we talk about using the existing frameworks to sort of go after these. And you saw that with Binance. They went basically do know your customer rules, things that normally apply to banks. And it was kind of interesting, too, because Binance even said, they disclose themselves, it's something like 12% they had actually categorized as basically, we don't know who these people are, which is like, I guess that's fine if there's no rule there, but the question is, do those rules really apply?
Yeah, at the same time, I just have to wonder, they are going after these outfits and they're shutting them down. Look at what happened to FTX. Look at what happened here. So at some point you say, well, what would we get if we had more regulation? Because don't they have the tools they need?
Well, that's been an argument that the industry's made too. They're saying we don't need new rules, just use the existing ones and that. But I don't know, it's kind of complicated.
Yeah, kind of complicated. Yeah. Certainly more complicated than I can deal with. Thank you so much. Tomorrow we're going to talk to Cornell University's Ishvar Prasad about Argentina's plan to dollarize its economy. And on Friday, we hear from former Council of Foreign Relations President Richard Haas. That's coming up at 6 p.m. Eastern Time on Friday.
All right, a lot of great stuff coming out of David Weston and the folks over at Wall Street Week. Meanwhile, back here on the close, we round out into the final hour of trading here on this Monday afternoon. Volume light and the price action relatively tepid. Most of the action, you're going to find that in the commodity space as well as in currencies. We'll be back in a moment. This is the close on Bloomberg. Just about 3 p.m. here in New York. This is the countdown to the close. Getting a view from the top right now. I'm Romaine Bostic.
And I'm Katie Greifeld.
A mixed day here in markets, Katie Greifeld. Hard to really get excited about too much of the price action. We're basically talking about fractional gains and losses. In fact, the only gain we're seeing right now, at least among the major indices, is with the NASDAQ, and that's only up about a tenth of a percent here. Meanwhile, the S&P 500 down on about 0.2%. And seeing a lot of activity today, believe it or not, in the crude oil space. Crude oil down once again here by about 0.6% over there in Europe.
Yeah, even still small moves. And it makes sense. You take a look at volume right now, still about 20% below its 20-day average. Definitely lines up with the very tepid price action that we're seeing overall.
Yeah, and flip up the board here, because now what you are seeing is not tepid price action when it comes to the dollar here. I was taking a look here. We had 2 straight weeks of losses for the dollar here, and we're setting up to start the week on another sort of losing trend. But more importantly, I was taking a look at just the monthly numbers here. And just for the month of November right now, we're down something like 3% on the dollar. And you have to go back to November of last year to see a loss that big in a month. Remember, we had that 5% drop last November in 2022.
Yeah, it'll be interesting to see where the dollar goes from here after some pretty ugly price action, very important for emerging markets as well. But let's talk about some of the U.S. equity movers right now. Keeping with the retail theme, I wanted to talk about Shopify, because Shopify having a great day, up about 4.5%. Of course, they had a very good Black Friday. The company said that its merchants set a Black Friday record with a combined $4.1 billion in sales. Sales were up 22% globally. You can see that's translating into a bump for Shopify, Romaine.
Yeah, I did not actually go to Shopify over the weekend, but I understand. I'm basically on some of the numbers we've seen. A lot of people really were kind of trolling around trying to find the best deals, and Shopify offered a lot.
Yeah, Shopify definitely gaining traction here. Let's also talk about Affirm, because we were talking about this a little bit earlier, this big uptick that we've seen in buy now, pay later. Adobe actually said that BNPL spending rose 72% last week from the prior week, and that when it comes to Cyber Monday today, expected to see a surge of nearly 19% compared to just last Cyber Monday. So you can see Affirm is definitely riding that way up almost 10% right now. Romaine.
But as of course you pointed out a little bit earlier in the program, the key phrase in that phrase is pay later.
Pay later.
And at some point, you have to make sure that what you're buying, you can actually afford to pay later.
Yeah, buy now sounds really good, but then the other part.
I'm all for that.
In any case, let's talk about Disney. Wish. It didn't go over so well. That was, of course, their new film coming out over the 3-day weekend. It brought in just under $20 million. That put it behind The Hunger Games. It put it behind Napoleon. So pretty disappointing showing. And you can see that disappointment leaking into Disney shares, currently off about 1%.
Did you see Wish?
No, not my speed.
Did you watch any movies this weekend?
No, not my speed.
Okay. Did you do anything this week? Did you eat?
I scrolled on TikTok, 6 minutes.
We are less, okay, that's food for the soul. 1 hour away from the closing bell. Our cross-platform coverage starts right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine Bostic alongside Katie Greifeld. We're joined right now by our colleagues Carol Masser and Bailey Lipschultz in today for Tim Stenovic. Welcome to our audiences across all of our Bloomberg platforms, television, radio originals, and our partnership on YouTube. Happy Monday, Carol Masser. Not a whole lot going on in the market today, but of course all the talk about consumer spending.
Yeah, absolutely, right? Cyber Monday, Black Friday, looks like the consumer's out and spending. But I mean, what a great deep dive by our Bloomberg News team basically is looking at what we are spending for everything. We talk constantly, right, about inflation being down. A lot lot in the past 12 months, no doubt about it. But prices are still higher than they were pre-pandemic levels. So you're talking about everything from groceries up 25% since January of 2020. You've got used car prices up 35% since then. Everything is still costing us more than it did before the pandemic. And Bailey, that's hurting all of us. And that's why we're kind of ticked off at the U.S. economy.
Exactly. And right now it costs $119 to buy the same goods and services that a family could afford with $100 before the pandemic. Carol, you mentioned it. We're seeing double-digit jumps across the board at grocery stores. We're seeing people paying up more than 34% jump in the cost of beef, coffee up 23% over the last 3 years. So everything getting more expensive, even when you're trying to buy cheaper at the grocery stores.
Right. Inflation, right? Not as significant, but it just means we're, going up at a lower rate, right, Romaine? I mean, we're still going up.
A lower rate, but there's a lot of psychology built into that too, Carol, because when you talk about everyone looking for deals and not really finding them, at least not in the way that they would have expected to see them this holiday season, I wonder how much that plays into it. If you're already affected by high prices and then you look for these holiday deals and you only get 20, 25%, I wonder, is that sort of the marker where you just say, I'm not going to do that? And we were speaking with a couple of economists earlier today who said, look, a lot of the purchases we're going to see this holiday season are going to be much more necessities rather than discretionary.
Interesting. Staples coming into play. Let's talk a little bit about
and
the
who doesn't
market.
like a can of soup for Christmas?
Who doesn't like a stapler? No,
I'll take anything you'll give me, really. Free food, I'll take it, even if it's in a can.
I'll remember that. All right.
Let's talk about the stock market.
Popcorners for Katie.
We've been talking about this bid for cash, this bid for safety that we've seen in the market really all year as the stock market gyrates. But there's a really great story out on the terminal by Emily Griffeo, one of the most read of the day, taking a look at dividend ETFs. These things were all the rage over the past few years, but you take a look at actual performance and they've really, really lagged. Maybe no surprise. You think about some of the companies in these dividend ETFs, and it's not the magnificent seven, the big tech type exposure that you're getting in other benchmarks. And as a result, you take a look at performance and you've gotten burned if you're one of the many investors who rushed into these things.
Well, that's what I'm curious about too, because I mean, we've seen this trend play out over the last few months. And I guess, does it come down to this idea of sort of what's in these ETFs, right? Like if you're not going after the big names like a Microsoft or something like that, and you're dealing with companies that do have cash flow issues or they have refinancing issues, is that what's scaring people and keeping them from going into these stocks?
Yeah, I don't know. It's kind of interesting because I do feel like we've had a lot of guests on over the last, 3-4 months that are saying, hey, here's a great way to do it. Look for those stocks that are paying high dividends. But if ultimately...
But did you see the names in that ETF, like the one that Katie had on the board? I think it was the Schwab. I mean, Broadcom is the biggest holding in there. Amgen, Coca-Cola, Pepsi, Merck, Home Depot, AbbVie, Texas Instruments. I mean, all great names, all great brands. But if you're looking for a real payout down the road here,
that's not it.
You're going to look for something else.
Yeah, it's not playing out. But the one thing to keep in mind, though, the group did return in 2022 almost 2%, and that coming with the S&P obviously taking it on the chin. So a bit of a reversal. It'll be interesting to see if people hold on to those losers, though, into 2024.
And you should do a thing. If you run EQS on the Bloomberg terminal, you could kind of sort through this. And I would challenge everyone, take all those names and look at their dividend yield and then stack that up against what you can get in the bond market, in fixed income, even in the commodity space. I mean, this is competition for return right now, and it's tough competition.
Yeah, and it's really hard to, once again, kind of outpace some of those growth names that they just continue to, despite everybody saying, okay, they're either overvalued, it's time for them to take a break, they continue to, outperform, and it's hard to kind of beat some of those returns. All right, guys, we're going to...
I didn't hear Bailey. Did Carol actually say what she got me for Christmas on this Cyber Monday?
It's not even December, It's just, you have to
now's
wait
the
a
time.
little.
If she wants to save.
The Croc cowboy boots. They're coming, Romaine. They're coming for you.
The Crooks.
The Crooks. Wow. All right, guys. That is a wrap. We're going to be back in less than an hour's time. Our cross-platform coverage will continue. Radio, TV, YouTube, and Bloomberg Originals. We'll see you for Beyond the Bell at 4 p.m. Wall Street time.
And we continue our markets coverage here on The Close, counting you down to those bells, which are just about 50 minutes away. Interesting survey out by the folks over at Bloomberg MLive. It's the latest Pulse survey, and it's all about ESG. And according to the results, well, 57% of respondents expect the sell-off that has actually ripped through a lot of those ESG stocks. That sell-off is going to continue into 2024. 43%, though, say we are near a bottom, and now might actually be the time to buy. Bonnie Wongzhikul is deep in this space. She's a portfolio manager, more importantly, the head of ESG investments over at Western Asset Management. Bonnie, great to have you here on the program. Hope you had a wonderful Thanksgiving weekend. Let's start off here with the sell-off that we've been seeing in the ESG space, and how real is that sell-off to you?
So within bonds, it's a very different kind of landscape than what we often read about in the headlines around ESG. So the ESG equities headlines are focused on clean energy stocks, tech. Within bonds, it's a very different kind of universe. And often what people are thinking about within ESG bond space is labeled bonds, ESG labeled bond issuance. So that's typically green bonds is the largest sector within that. And that has been a very robust sector and has performed well. Of course, within bond space in general, we've had a difficult year, but as we know, fixed income is now moving into the green. We're seeing really positive price action there. Over the past month, we saw the Treasury market move a lot, cover a lot of ground in a very short period of time.
Yeah.
You know, the 10-year is down over 50 basis points, but we think that direction of travel is the right one.
Well, I'm glad you brought that up because there's been a lot of discussion about the downturn that we've been seeing in some of those ESG names, whether you're talking about in the fixed income space or even in the equity space as well. But I guess the broader question really becomes, and let's just stick with fixed income, whether that downdraft was really just kind of a reflection of just the broader downdraft that we were seeing in the fixed income space or something specific to ESG.
I think that's right. I think it's correlated more with the overall fixed income market than it is something specific to ESG. Within, again, going back to green bonds, that issuance is actually stronger this year if you compare year to date versus last year. So I think that the demand is still there. We still have a lot of clients that are very committed to sustainable investing that seek out this type of paper and this type of expression within fixed income to show their commitment to sustainable investing.
Well, just to meditate on ESG a little bit longer, I want to talk about demand because I look at the ETF world and you take a look at ESG ETFs and they're headed for record outflows so far in 2023. And when I'm talking to people trying to get an answer for why we've seen demand flip from huge inflows to now huge outflows, I keep landing on it's because ESG has become politicized. I think it was Larry Fink who said that it's become a weaponized term. How are you thinking about that? And what are your conversations around ESG with your clients sound like given that backdrop?
Well, there's definitely an education element because, yes, to your point, Katie, there's a lot of politicization of the term ESG and what does it really mean. So the first step is really understanding what ESG integration is. And that's really what most of these funds that have seen the outflows, they are using integration. It's very different from, say, an impact fund or a green bond fund. They're simply integrating certain factors. They're usually integrating third-party ratings to construct an index that is pretty similar to a broader index, S&P, but just has a different weighting based upon, say, an ESG rating. So it's really not giving you what you might be seeking if you're really, truly looking to do sustainable investing. And I think the issue kind of starts there. Within, again, bonds, it's going to be a very different expression because we don't have those indices. I mean, there are indices, but people typically don't use them. It has to be a much more nuanced expression that isn't about MSCI ratings or certain industry tilts or exclusions.
All right, Bonnie, point taken there. And let's zoom out from just ESG and talk about the market at the moment, because we've talked a little bit about rates, about sentiment, and you take a look at where opportunities are, specifically in the fixed income universe. I see in your notes you're taking a look at CLOs right now. What's the pitch for CLOs at this moment?
Well, generally within just the broader space, we just think that staying higher in quality makes a lot, excuse me, a lot of sense. Specifically because A, where we are in the cycle, you know, it's pretty advanced and there's more downside risk, but also just spreads in general. And so we think staying up in quality makes sense. And within CLOs in particular, that highest rated tranche, the AAAs, you're going to get yields that are well north of 6%. So we do like that. As well as other parts of the IG universe. We do still like the shorter end of the curve, 1 to 5 year corporates, which are yielding around, 5 3/4, again, for investment grade rated paper.
All right, Bonnie, got to leave it there. Hope to check in with you again soon. That is Bonnie Wong-Trickul. She is portfolio manager and head of ESG investments over at Western Asset Management. Now, coming up on this Cyber Monday, we'll get insight on the holiday shopping season from Mickey Drexler, chairman of Alex Mill and the former chairman and CEO of J. Crew Group.
Plus a conversation with Alejandro Mayorkas, the U.S. Secretary of Homeland Security, a focus on supply chains and protecting our borders.
And Merriam-Webster has chosen its word of the year for 2023.
What is it?
We'll give you a hint. It's related to the AI boom. The answer and more coming up. This is The Close on Bloomberg.
Welcome back to The Close. We're learning today that the Biden administration here in the U.S. is doubling down on measures to strengthen supply chains. That means expanding efforts that it credits with helping to ease post-pandemic inflation. Here to talk a little bit more about what we know and what is to come is U.S. Secretary of Homeland Security Alejandro Mayorkas, joining us from the North Lawn of the White House. And Mr. Secretary, let's start off here. I mean, this was the first meeting of this new Council on Supply Chain Resilience. Supply chain resilience that the president himself says is necessary to protect the U.S. from evolving threats. What type of threats is he referring to?
I think the threats that the president spoke of are quite varied. It ranges from the impacts of climate change that can so gravely impact our access to goods and supplies upon which we rely, to nation-state competitiveness, and including adverse nations and the steps they could take to disrupt matters that really impact the American public. It's very important to realize that supply chain security and supply chain resilience is not just a matter of economic competitiveness, not just a matter of economic security, but a matter of homeland security as well. And we saw that very starkly during the pandemic when there was a shortage of supplies and medical goods upon which the American public relied.
Is there a sense here, though, that the federal government's involvement, particularly in a space that we know has a lot of private actors, meaning private companies, that have a lot of control, whether it's of our ports or our borders or other sort of means along that supply chain, how much coordination can you do in that space without just fundamentally rewriting current laws?
I would say three things. Number one, we rely upon partnership, a public-private partnership. And in that way, we really advance not only the federal government's interest in protecting the American public, but quite frankly, American business interests in enhancing our competitiveness, number one. Number two, we have regulatory authority, so we can help drive businesses to do what the American public needs. And number three, we also have separate tools, such as the Defense Production Act, which can really prioritize the production and distribution of goods as the American public needs most. We have a number of tools at our disposal, but ultimately, and I think the foundation is a partnership on behalf of the American people and the American economy.
And Secretary, I want to switch gears here from supply chain security to border security. And if Congress doesn't approve the supplemental funding that the administration has requested, how do border agency plan to manage the situation that's going on at the border?
Well, I'm actually confident that Congress is going to provide us with the funding that we need. This is about the security of the border, giving us the personnel, the facilities, the resources, the technology that we need to best protect our borders, to secure the border most effectively, and not only to secure the border, but also to advance our fight against fentanyl, which is the #1 killer of young people between the ages of 18 and 45.
Is there a plan in place, though, if that funding doesn't come through?
We have a model in place that we are continuing to advance, and that is the model of building and promoting lawful pathways, giving people a safe, orderly, and lawful means of accessing humanitarian relief in the United States, and to deliver consequences for those people who do not take advantage of those lawful pathways, but instead arrive irregularly at our southern border.
What measures, though, are in place right now to address some of that? I mean, a lot of what you're talking about are much more longer-term issues. A lot of those issues you're talking about are going to require some sort of congressional action. A Congress that I'm sure you know doesn't really seem to be in a mood to give the Democratic Party and your president any sort of leeway.
Well, let me cite some examples. We have a parole program, a humanitarian relief program, where case by case we make a determination for people from Cuba, Haiti, Nicaragua, and Venezuela, whether they could qualify for relief. We have sponsors here in the United States that assure their financial independence. And if, in fact, those individuals are approved, then they can come safely by air to the United States, outside the grip of unscrupulous and ruthless smugglers,
Right.
they can come safely to the United States. If they don't take that path, they arrive irregularly at our southern border. They do not qualify for relief under a heightened standard.
Yeah.
They can suffer a 5-year bar to admission to the United
But
States.
you have to know, you have to know that's not going to be a deterrent for a lot of folks who are trying to escape very dire conditions. It also doesn't address the other sort of elephant in the room, which is dealing with the undocumented immigrants who are already here in the nation. And I know it's been a political football as they're trying to figure out the best way to address that. But I'm going to ask you, what is the best way to address that from your perspective?
The answer is quite clear and quite straightforward, and we've been waiting for it for about 30 years. And that is to fix a system that everyone agrees is fundamentally broken, and we need congressional action, both for the lawful pathways that really need to be more robust in statute, and for the 12 million people who are here in the United States who have been contributing so fundamentally to our country's well-being. They're our neighbors, our friends, our fellow congregants. They provide our frontline workers. We need to do something, and I am hopeful and remain hopeful that Congress will do it. The president, on his first day in office, presented Congress with a proposal.
They did, and the Republicans also have their own proposal. The Republicans have also tried to remove you from office. Has that shifted at all your strategy, given what they themselves, the Republican Party, has put out there?
I am busy at work and incredibly proud to support and work alongside the 260,000 people of the Department of Homeland Security.
All right, Mr. Secretary, you're going to have to leave it there. Homeland Security Secretary Alejandro Mayorkas speaking with us here about new initiatives to protect the border as well as the U.S. supply chain. We'll be back in a moment on The Close on Bloomberg.
Authentic is officially the word of the year in the eyes of Merriam-Webster. The adjective, which means not false or true to one's own personality, spirit, or character, saw a high number of lookups in the past few years. That, of course, driven by conversations about artificial intelligence, pop culture, and social media. Romaine, authentic.
Authentic. I guess. I don't know. I didn't realize that was actually a word that I heard a lot. I was going through the list of words, and authentic obviously is a word of the year. They had Riz on there as well, which all the cool kids are using as a reference to charisma.
I do see that, yeah.
Yeah, you got a lot of Riz here. And then, of course, you have EGOT.
Yeah.
That define why? Did somebody get an EGOT this year?
I don't know.
I missed that, but that's when you win an Emmy, Grammy, Oscar, and Tony, and I'm only 4 awards away from getting those.
Okay,
EGOT.
that's close.
So I'm there. Got to
Yeah.
think positive. And deepfake.
Another AI word, of course, deepfake is when you fake someone in a video, which can be very convincing. I'm sure you've seen those.
Yeah, I'm just waiting so I can utilize the deepfakes. That way I don't have to show up to work. I can just have my deepfake do the job.
Don't worry, that's coming for our job.
Dystopian, gaslighting, and indict also on the list. I don't know how that makes me feel.
This is The Close on Bloomberg.
This is the countdown to the close. Just about 30 minutes left to go here in the trading day, Katie.
And it's a pretty boring day, so let's see if we can find some excitement.
We gotta spice it up.
When we take a look at the sector level, we do have a few more things to talk about. Of course, there is more red than green on this screen, but up at the top, you do have real estate having a decent start to the week. Real estate up about 0.6%. Consumer discretionary also finding some green as well. Then big tech hanging on as well. But then you go down the list to what's not doing too well, and there's plenty not to like. Industrials, healthcare, and then energy at the bottom with 0.7% when it comes to losses. Still small moves overall, especially compared to what we have been seeing.
Yeah, absolutely. As far as some of the individual movers, Katie, believe it or not, we're still in earnings season. We're going to get a slew of software companies this week, including a lot of cybersecurity names. That includes Zscaler, which is scheduled to report after the bell later tonight. But of course, our focus today really is about the consumer coming off of Black Friday here on Cyber Monday. And you can see some of the beneficiaries, at least in the markets, of all the hype. Shopify getting a pretty strong bid here on the day, up about about 5%. But it's not actually the folks selling the goods and services that are getting the bid in the market today. It's those companies that are financing the purchases, and that includes Affirm having a phenomenal day, up 12%. At one point, Katie, it was up 16%.
All right, well, on the topic of retail, we do want to bring you some breaking news here. Kim Kardashian's Skims is said to mull options, including a potential 2024 IPO. Again, this is breaking news. We'll bring you more details as we have them. But of course, we know that Skims is a very popular shapewear brand that has really found its market. And now we know and are learning in this breaking news that looking at a potential IPO in 2024, among other options, will continue to follow that stories. But let's stick with the consumer, because it appears that U.S. consumers are spending big this holiday shopping season. According to Adobe Analytics, Black Friday online spending hit $9.8 billion. That is a jump of 7.5% compared to last year. Meanwhile, Cyber Monday today, spending is expected to reach up to $12.4 billion online. And joining us now to discuss, I'm thrilled to say, we have Mickey Drexler. He is chairman of Alex Mill, of course, the former chairman and CEO of the J. Crew Group. Let's talk a little bit about Black Friday, because we know that the online spend has just been incredible. But when it comes to the Black Friday, which involves waking up extremely early, lining up at the mall, are those days behind us?
Well, I hope so, but I don't think so, because people like to buy business. Now, the more volume they do, the lower their profit margins are. And most of the retailers are very dependent on the two probably most marketed days of the year: Black Friday, get a deal, and Cyber Monday. For me, we're small at Alex Mill, small but good, and we say we don't put things on sale because we say it's just another Friday. And if you have things on sale, customers can't feel good if they shop a week later and what they bought a week ago or 2 weeks ago is cheaper price. And that hurts the integrity, in my opinion, of people who go on sale, but everyone's on sale.
Well, you mentioned two very important days, of course, Black Friday and Cyber Monday, but we've seen such a huge pickup when it comes to online Black Friday shopping. Is the distinction still meaningful there?
Well, it's easier to shop online than to deal with the shopping malls and the lines at stores. You know, I guess I read that 7% sales increase in online and 1% in retail. But it's easier to shop online, in my opinion.
I am curious, though, about the discounting and how you sort of get out of that loop. I mean, we've seen a lot of retailers sort of fall victim to that they are constantly offering discounts, which means that the consumer always expects a discount, which means that they can never really ever sell anything at full price. And I'm glad you mentioned Alex Mill and not doing that, because I have noticed that some of the smaller brands out there were not offering any material Black Friday deals. And if they were, it was very nominal, like free shipping or something like that. What does that do in terms of brand loyalty and, more importantly, return customers if you don't actually have those discounts and promotions?
I don't know many companies that have taken the needle out in terms of promotions. They all say they'd like to. But in America, we have trained the consumer to look for sale, to defer their shopping until there is sale. And I imagine the next couple of weeks is going to be very difficult, and people will put everything on sale, if they're not already, before the holidays, and people will wait. I mean, everyone's been trained, sale, sale, sale. And those that really do very well in this times are the discounters, because they're every day on sale, and they're professional sale people. So
what gets you, though, to the point where you feel like you have no choice to do that? I mean, you're obviously a chairman of Alex Mill, you're a J. Crew, you're a Gap, I think Williams, Snowman, Taylor, a couple other brands out there here. And we've seen kind of this cycle with all of those names, where they've gone from kind of full price to, okay, let's offer a few discounts, to all of a sudden everything is discounted all the time.
Well, I think it's kind of price bingo in a way. And I think it alienates quality consumers, because discounting is kind of a game among a lot of customers. At TJX, which is probably the best in the world, discounter, it's kind of a treasure hunt for people who go there. And most brands that they carry are carried at regular price in their accounts, department stores, et cetera.
Interesting.
So
And when you think about what we learned, what happened on Black Friday, the numbers that we're going to get out for Cyber Monday today, and you think about the magnitude of discounts being offered, maybe not the 80% discounts that we saw maybe a decade ago, how does that set us up for the holiday shopping season, specifically as we get closer or further into December?
Well, I think this year the discounts have been bigger than ever, lowers the margin, and the time the sale started for Black Friday could have been up to 2 weeks prior. I think it's going to hurt a lot. Why? Because people are really smart. The consumer's smart. And companies are putting 50% off everything or 30% off everything. And for me, what I learned is the best things sell first if everything is equal discount. And, it's, if the veggie burger's not selling, then they mark down the veggie burger and the hamburger. So, I think that's what's going on now.
Yeah. I do want to talk a little bit here, Mickey, about just style trends overall. I mean, in addition to being a great businessman, you are a style icon. And I think to this idea that you're hearing about now of quiet luxury, the idea of brands that don't necessarily have the labels on them, but still sort of exude a certain personality to them. And I think some people can argue that places like J.Crew and Gap were kind of at the forefront of that years ago, even if they didn't know it, they were. Do you think that's a trend that is going to sustain itself?
Well, I don't know what quiet luxury means.
Okay.
Because most designer businesses now, first of all, the prices to me out there, insane. You need a mortgage to buy a lot of those goods. But I think, personally, they're mostly logo businesses. Handbags, probably the biggest category. You know every handbag walking around the streets. It used to be a little more special, and now it's become, in a way, mass. But I don't, quiet luxury, I don't know who made that up, but what's quiet about luxury? I think good style, good taste, no logos. It's quiet.
But some people will also say they want the look. I mean, otherwise, why would you spend $6,000 on a Balenciaga handbag if everyone doesn't know that it's a Balenciaga
It's only
handbag?
$6,000, I thought it was.
I know. I bring that up because I was in the store with my mother this weekend, and she pointed out a handbag that was very nice, and I went to look it up, and I thought, you're not getting that.
It's unbelievable. But I don't think it's going to ever stop. People want status. I can't believe the prices. Those companies don't go on sale. And then the used bags, like at Hermes and wherever, they're at a big premium.
Yeah.
So, but I quiet luxury, I would define it as good taste, good style, no logos.
All right. We're going to have to leave it there. Mickey, that's a great place to end it. Mickey Drexler, he's the chairman of Alex Mill and, of course, formerly ran J.Crew, Gap, as well as a few other brands here. Stick with us. We'll be back in a moment. This is Bloomberg.
All right, time now for the top three. Every day at this time, we do a deep dive into the people at the center of today's top stories. Scarlet Fu, who do you have your eye on?
I'm watching the one and only Elon Musk. He is visiting Israel as part of a diplomacy tour to push back against accusations that he's anti-Semitic. Remember, just under 2 weeks ago, he amplified anti-Semitic content on X that led Disney, Apple, among others, to suspend advertising there. And so far during his trip, he's met with Israeli leaders, including the prime minister and the president. He's also visited an Israeli town devastated by the October 7th attack. He described that experience as jarring. He's also saying he would like to help rebuild Gaza after the war with Hamas, but he says a lot of things.
Yeah, he says a lot of things. He manages to make his way into the news, it seems like, on every issue. I know that he's in talks with Israel over Starlink. Of course, that is his satellite-based internet service, but whether or not that can actually be used in a time of crisis, I guess we'll see.
Yeah, we'll see what he says, and that'll change day by day.
All right, I've been keeping an eye on one of the biggest deal makers out there, Steve Schwartzman over at Blackstone. Interesting, he actually said that, look, the deal business is actually not dead. He had a chance to sit down with Francine Lacroix to talk a little bit about where he is seeing some buying opportunities. Let's take a listen.
We're seeing a good deal of volume of buying things in Europe because European real estate is under pressure. The deal business is not totally in mothballs, and these things start again. And I think we're more on that side of the cycle, although it has been, somewhat dreary for a year.
And one other thing I thought was interesting that Schwartzman said in that interview, he was talking about this idea of what limited partners are looking for, because there's been a lot of concerns here that they're not getting the returns that they had been promised, and more importantly, their money is still locked up. But he said, don't worry, this is just kind of part of the cycle, and everything will return to normal.
I like not totally on mothballs. That's not a ringing endorsement either.
Well, it's better than dead, I guess.
Yeah,
that's true. That's true.
Who are you looking at, by the way?
I'm looking at Martha Stewart. I'm so excited to talk about her. The Wall Street Journal reporting that her 150-plus acre property in Bedford, New York, is open for rent for a night. She joins a list of A-listers, including Gwyneth Paltrow and Mariah Carey, putting their estates or penthouses up for short-term stays on rental sites like Airbnb and Booking.com for very low fees. Specific to Martha Stewart, the getaway over the Thanksgiving holiday was $11.23.
So what is it going up to? Because I keep seeing this $11.23 number, and I assume that's just like some promotional number. For
November 2023.
Well, I get that. So what is it? So it's November 27th. Do I pay $11.27 now, or is it like $1,127?
I think I'm going to have to figure this out. Go on Airbnb and try to figure it out. But to pay that, to actually get
Here's a question: is Martha Stewart actually going to be there when I'm renting?
I think she's going to.
If she's going to be like baking me muffins in the morning, I will pay any amount of money.
You'll have to sign an NDA, though. You'll have to sign an NDA. You can't talk about it or tweet about it.
I'd do that. I would love that. She seems like pretty cool, actually.
Romaine and Martha Stewart hanging out. That's a scene.
This is the countdown to the close. I'm Romaine Bostic. Scarlett Fu joining me to help take us to the closing bell and beyond. And Scarlett, I'm taking a look at the price action today and the volumes, and I don't know. I'm not sure.
Impressed.
I need better glasses here because I'm not really seeing much of anything.
Yeah, this is the fourth straight trading day of the S&P and the Nasdaq, each moving less than 0.5%. The last time anything did any of these indexes did anything of note was a Monday a week ago. But there's a lot of data coming out that could push things in a direction, some kind of direction. PCE on Thursday will be a big one, and of course Jay Powell speaking on Friday.
Jay Powell speaking on Friday.
Yes,
wow, we got to go back to the Fed speak, and and actually a big week for earnings as well too. At least in the software space, including Salesforce and a lot of the cybersecurity companies. So a lot of potential catalysts here. We should point out, I was just looking at the volume. I mean, we're down like 26% here versus where we would normally be. So I guess a lot of people still on their Thanksgiving break.
It was pretty empty at the train station parking lot, I have to say.
Yeah. All right. Well, let's see if things pick up here over the next few days. A lot to talk about. Let's get some insights out of Lauren Goodwin, economist and portfolio strategist at New York Life Investments, joining us here in studio too as we count you down to the close. And Lauren, I do want to start off with some of the economic data that Scarlett was referring to, because our folks over at Bloomberg Economics, they had a great note. Anna Wong was talking about this idea of the markets being priced to perfection, but almost to a point where they seem to be kind of ignoring a lot of signs that say that soft landing that everybody's waiting for, that's not actually coming.
That's a perspective that I agree with. I will say that I expect over the next 4-6 weeks that we will see a pretty durable Fed relief rally, because the come down in inflation or price growth has been meaningful. I do expect that the Fed will pause, and that's good news for the economy and markets. The challenge we have as investors is that the reason that the Fed can pause is because economic growth is slowing, and employment, I expect, will be the next domino to topple.
And we're already seeing softness in the labor market. I mean, you can even just put inflation aside for 1 second. But this is what the Fed wanted. I mean, they wanted a softer labor market, or at least a labor market that was soft enough to keep wages from completely spiraling too far out of control.
That's exactly right, and it's one of the reasons why I don't expect the Fed can cut until we have an unemployment rate that is higher, because that's what gives the Fed the confidence that wage growth can come under control. It's one of the elements of the soft landing narrative that I just can't square. The idea that eliminating just job openings is enough for the Fed. I do expect that economic growth will need to slow further, and that's what the lagged impact of Fed hikes will give us here in the next few months.
And I'm so glad you point out how it doesn't really make sense that the consensus is there's going to be a soft landing, yet at the same time the Fed is going to begin cutting interest rates in 2024. I mean, there's a big difference between a Fed pause, which is driving this Fed relief rally, as you point out, and actual rate cuts. Things have to get really bad for there to be rate cuts, right?
That's my perspective. The proponents of the soft landing narrative have a point. It's one of the reasons why we've been debating all year which way the market will turn and the economy will turn, which is that as the Fed maintains a higher for longer interest rate and as inflation comes lower, then real rates are necessarily higher, and that can constrain the economy. The reason that I do expect that we'll have to see growth slow further is because those long and variable lags of not just Fed tightening, but also bank lending standards tightening and financial market conditions tightening, those are still making their way through the economy. And that points to slower growth, slowing inflation, and eventually the market will react to that. The key for investors, though, is that the markets tend not to react until we're already there, already in recession.
Yeah, they'll look down and say, oh my gosh, here we are. So what is the best way to position for months of uncertainty as we try to figure out whether it's going to be a soft landing, a hard landing, or wait until there's actual evidence of a hard landing?
Well, the challenge for investors is that over the course of this year, despite so much ink spilled over this soft versus hard landing debate, neither one has been the key place to be for investments. What's really been the right way to play has been looking at quality. Now, as we move later in the economic cycle, which is where I believe we are, quality starts to take on a new meaning. For me, I think it starts to look a little bit more like defensive sectors. I really like infrastructure equity as a way to harness utilities, digital infrastructure, some of the more durable investment themes we heard from President Biden earlier today. Larger companies tend to be the play late in the cycle, although I think for tech companies, small and medium-sized companies may be a more balanced way to harness artificial intelligence trends. And then when we look to bonds, I think we can start to add duration within reason. And high yield is one area where I expect higher quality in the asset class to add value to investor portfolios.
Is that because it's been beaten down so much, or you see something else there?
Well, actually, over the course of the last economic cycle, we saw improvements in quality in the asset class as some of the middling borrowers in that space moving into the private markets or into floating rate asset classes. That made sense then. Yeah. And what that leaves us is a high yield asset class that's higher in quality, more bifurcated, which allows investors an opportunity to harvest higher yield, taking equity-like risk.
Yeah. Well, I mean, I'm glad you brought up the equity side of it, because we were having this conversation earlier about some of those kind of mid and kind of smaller companies, but we were looking at it also from the equity perspective and the dividend payouts, and the idea that some of these companies have pretty attractive dividend yields, but people still aren't buying them, I guess, because they're fearful that given the financial position of those companies, that if times are going to get a little bit worse than where they are, maybe it's not quite the right time.
I think that's right. There's an element of throwing the baby out with the bathwater with some of these smaller companies because, as we know, about 40% of small caps are unprofitable. So the key for investors is really to look at dividend payout, to look at profitability, and to look at viable business models. The reason that larger companies tend to perform better late cycle is because they have the administrative overhang to handle higher rates, which is where we are today. So the key is finding that in small and mid-sized companies.
Good point. Yeah.
So the first half of the year, there was a lot of excitement over AI. The second half of the year, there was excitement over Ozempic. Do you have any sense of what's going to be the source of excitement in 2024, if you had to guess?
I think that we'll be very focused on risk in 2024, risk mitigation. But let me say that I think the artificial intelligence conversation is here to stay. In 2023, it was all about realizing that it was here. In 2024, I think the conversation is going to be more about the supply side of the economy. Are investments in artificial intelligence and digital infrastructure likely to help bring inflationary pressures lower, improve productivity? I do think that will be the case in the medium term. My perspective is that we won't see it in this cycle.
All right. Great to talk to you as always, Lauren. Lauren Goodwin, economist and portfolio strategist at New York Life Investments, helping us count down to the close, which are just about 3 minutes away until we get to those bells. Scarlett, volume right now at this particular time down about 26% from where it would normally be.
Yeah, not a whole lot to get excited about. And of course, we had Treasury auctions that kind of offset each other, right?
Yeah.
The 2-year was meh. The 5-year was a little bit better. No one drew any conclusions from it, really.
Yeah, it was hard to draw conclusions from any of the price action. But like I said, there's some big economic data, the housing data, the PCE data at the end of a week, and of course some of those earnings. And then if Jay Powell comes out and starts flapping his gums again, who knows where the market's going to go.
And a second reading of GDP as well. Third quarter was gangbusters.
Which was, a phenomenal quarter.
We'll see if that's been knocked down.
Nobody picked that at the start of the year.
No, that was a complete surprise. That's why the recession talk is all out the window.
Stick with us. We're moving closer to these closing bells. Our full market coverage starts right now as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick and Scarlett Fu, we're counting you down to the closing bell. Here to help take us beyond the bell, it's our friends Carol Massar, Bailey Lipschultz in today for Tim Stenovic, and a welcome to our audiences in full across all of our Bloomberg platforms. A relatively modest day in equity markets, a relatively modest day, pretty much every asset class out there, Carol, as I think a lot of folks still away on the Thanksgiving Day holiday.
Yeah, it feels pretty quiet still. What's interesting, though, and I feel like the equity market kind of meh, but it's interesting to see the movement down in yields once again. We just had Liz Capel-McCormick on just talking about, could it be that this is, we're growing into an environment where maybe yields have peaked, dare we say, and that it's quite a turnaround for investors in the U.S. Treasury trade.
Yeah, we've got some economic data on the horizon. Jay Powell at the end of the week, but just looking at the volume, about 15% below what's been average over the last 100 days on the S&P 500. Larger drop off when it comes to the Dow. So to your point, Romaine, feels like people extending those Thanksgiving holidays ahead of what could be a busier week.
Yeah, you have a fourth straight day of the S&P and the Nasdaq moving less than 0.5%. Maybe earnings will shake that up a little bit.
I do wonder too about economic conditions. I mean, again, on a day where you're seeing a lot of kind of industrial stocks and a lot of kind of the, I guess, the real economy, if you will, kind of stocks moving lower, makes you wonder kind of what this market is pricing in. I mean, the biggest movers today are what? A lot of retailers?
Yeah.
Domino's Pizza?
I had to look up the tickers. That's how kind of a day it was when it comes to gainers.
That's exciting.
Well, it should be fun. We're going to have fun with Carol as she tries to walk us through some of the big movers on the day, which I'm sure should be interesting. Nevertheless, we get the closing bells here in New York. Modest losses across the board for all of the major indices, with the Dow down about 0.2% here on the day. The S&P down by a similar amount. The Nasdaq Composite down by about 0.1%, and the Russell 2000 down by 0.3%. And I should point out that the biggest laggard in terms of the big indices out there are Dow Transports, which dropped 1.3% on the day.
All right, so interesting. S&P 500, just looking at the breakdown, about 174 to the upside. Scarlett, we've got 326 to the downside, 3 unchanged. So a little bit safe to say more of a negative tone or risk-off tone when it comes to the big cap names.
Yeah, definitely things are skewed to the downside. You look at the industry groups in the S&P 500. Romaine, you mentioned the Dow Transports. The transportation index in the S&P 500 was the biggest decliner, off 1.6%. So that's railroad companies and airlines. Pharma is off by 0.8%. Food, beverage, and tobacco down 0.5%. Among the gainers, not a lot of exciting groups here. Real estate investment trusts up slightly. Retailers up by 1/3%. I mean, barely up at that point. And autos and components leading up the rear.
All right, folks, so let's get to the individual gainers.
Oh, yeah.
Da, 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 drum roll, please. Affirm Holdings. You're going to like these, actually, Romaine. You're going to be pretty happy.
Yeah.
Up almost 16% at its highs today, finishing the day with about a 12% gain. We were just talking with Poonam Goyal of Bloomberg Intelligence about all the shoppers that are out there, about the rise, both on Black Friday and Cyber Monday, this buy now, pay later programs. Well, Affirm is the home of buy now, pay later programs, rallying and hitting a 52-week high in today's session. Shopify merchants posted record Black Friday sales. Adobe boosting its forecast for Cyber Monday spending. Adobe saying that orders using BNPL were up 72% on last year across the week going into Black Friday. And this was a report by TechCrunch. Affirm shares, by the way, up almost 200% year to date. And as we said, another 12% today. Another name that caught our attention, number 3 gainer in the S&P 500, Crown Castle.
Yeah, I'm
You're
into
gonna
this
like
story.
this.
Yeah.
I know you are. 3.5% higher. You know what they do, right?
Yeah, it's like cell phone towers, right?
Yeah, exactly, right? Something we just kind of take for granted, right, that this stuff all kind of works. But they actually do it, the infrastructure to support all of our cell service. Well, top of the S&P 500, Elliott Investment Management, they've been pretty busy, confirming a $2 billion position in the company, sent a letter to the board. They want significant leadership changes. This is about a $47 billion market cap company, so we'll keep an eye on that one. And Domino's, you mentioned it. It's not just because I love some pizza. Number 1 gainer in the S&P 500, Cowen raising its price target on the stock to $4.30 from $4.10. Stock closing at $3.87 today. Bullish on Domino's U.S. turnaround as it models above consensus 2025 estimates. No, I kind of like artisanal pizza. I like a really thin crust. I like it burnt. I like a coal oven.
Oh, that sounds really good.
Right?
Okay.
I know. Are we all hungry now? But I do like pizza. Like if you're in a crunch and you're in a car, A little Happy Meal or a little Domino's, it'll work.
I'm more of a fan of the Detroit style. There's a place by my old apartment that made a nice Detroit style pie. But looking at some of the worst performers, GE Healthcare among the bottom 5 performers in the S&P 500. This coming after UBS downgraded it to a sell rating. Remember, less than 10% of ratings on Wall Street are a sell equivalent. So when someone comes out outright bearish, that can drive shares to drop. GE Healthcare having its worst sell-off since May. Basis of the downgrade really focusing on valuation, a softer order trajectory, and tough comparable sales for the year ahead. So uncertainty for what had been one of the better performing spin-offs of the last 18 months. Another stock underperforming after an analyst downgrade, Lucid Group. This coming after Needham cut the stock to hold from buy, saying it's less optimistic about its ability to license its EV technology, saying it doesn't have faith in near-term demand. Shares down nearly 60% in the last year.
And I wonder how much of this, though, too, is also just about just EVs overall, just kind of seeing depression. I mean, you saw the downdraft today in Fisker, and then I was even looking at like the lithium companies that had really been the big beneficiaries, and they dropped a lot today. I think Albemarle, what were they down? 6% on the day.
Yeah, worst performer in the S&P, Romaine, and that does seem to be kind of the issues and concerns around EVs playing out, and maybe there won't be the demand for a pull forward in demand as everyone kind of swaps out their normal gas
they're
engine.
putting out the Cybertruck this week.
Yeah.
Did you get one?
I did
Is that
not.
going to happen, though? Is that really going to happen?
I mean, Elon Musk said it would
Is there
happen.
a Cyber
so why shouldn't I
Monday deal on
believe?
that puppy?
He's never lied.
Buy
to us
one,
before.
get one free?
No, never.
I just wish it had a bigger trunk space. I don't know if it was real, but I saw something. I saw a meme on X that showed it couldn't even hold a bicycle. Which
I saw
don't
that
know.
too, but I never know what to believe on the internet now.
Exactly. If you have a Cybertruck that looks like it's from a futuristic movie, at least have a real truck.
Better would actually be able to like tote a bicycle.
Yeah, exactly.
Okay, there you go. I don't know. There are no bicycles in the apocalypse, Bailey. What else you got?
Well, we got to be outrunning it. One thing to keep in mind, one of the worst performers among smaller companies, iRobot dropping more than 15%, biggest drop since January 2021. This coming after its $1.4 billion sale to Amazon received a EU warning on competition, warning that Roomba maker deal could hurt the market for robot vacuum cleaners. I don't know if you have one of those, Romaine, but apparently Amazon will be could be at risk of promoting their own product.
They're fun for the pets in the house.
Well, not my dog. She would tear that thing apart. That would last about 2 days here. We are, believe it or not, still in earnings season. Zscaler, the cybersecurity company, announcing earnings right now. Shares down in the after-hour session here. Here are your numbers here. For the fiscal first quarter, revenue did beat $496.7 million. That was slightly above street estimates, as was EPS, which came in at 67 cents, and the street was looking at about 49 cents a share. But here seems to be the issue here. The street was looking for a bump up in the forecast, and that forecast is relatively staying the same. The company saying it sees full year calculated billings in that range that it had previously given of about 2.52 to 2.56 billion. The company also saying full year EPS will be at 245 to 248. That's actually slightly higher than the range it had given before here. But it looks like on the revenue side here, looks like a little bit of stasis, and I think that might cause a little bit of concern given that billings growth for this company have been tracking at above 30%.
Yeah, you wondered if there's an overall theme to be drawn from these cybersecurity companies, because Fortinet had really disappointed investors, and then Palo Alto Networks came in, and yes, it lowered its estimates for the full year, but there's the sense that it's in a better position than Fortinet. So the sentiment on this group was already fairly negative.
And I think Bloomberg Intelligence put out a great note on this idea of a lot of clients, I should say, the enterprise clients looking to consolidate their software products, and that this could actually come at the expense of some of these standalone companies like a Zscaler or like a Okta, et cetera.
Yeah, that
and
really makes sense, right?
Microsoft and Salesforce and those types of
Yeah, you think about all the different programs, right, and platforms that they're doing, and then at some point they've got to kind of consolidation make some sense. The one thing I will say about Zscaler, they've been on a tear. They're up 71% this year. About 6% of the outstanding of the float is shorted, and it's quite a pricey valuation. So this disappointment doesn't surprise me to see that kind of the shares coming down, because expectations were pretty high on this one, Bailey.
Yeah, I was going to make the same point. When you look at the numbers, they've beaten on EBITDA in 5 of the last 6 quarters, and they actually sold down more than 10% last year. So high bar, obviously, when your stock's ripping, and that does seem like we're playing out one of those price to perfection companies.
And don't forget, tomorrow we get a lot more of these names, including NetApp and CrowdStrike. I think Splunk is also on deck, and then you get kind of those broader software names like a Salesforce, a Workday, et cetera, Snowflake. So it'll be interesting to see kind of how, at least in my mind, corporate spending, enterprise spending is holding up, whether the money is just shifting around or whether it's actually going down.
Yeah, people are cutting back, right? If they're starting to feel a little tight in terms of where they're
Do they
doing their
give Black
spend.
Friday discounts in the enterprise software space?
Yeah, is there Black Friday discounts for B2B?
What is it, Rakuten?
Is that what you're asking?
Rakuten, does it have a coupon? Like,
Rakuten.
you know?
Remember that? Remember that big Super Bowl commercial? Yeah, that really took off after that.
I
You
don't
should
know.
be asking for it now.
Somebody's going to hook
How do
me
you
up with
pronounce
that.
it?
Isn't it Rakuten? It's Rakuten.
That was the whole commercial.
Oh,
It's
is
telling
it?
people how to
I don't
pronounce it.
remember. You know,
No,
what
no.
can I tell you?
Jokes over Carol's.
I was too into the nachos. All right, we are going to. What did you say? It's a wrap. Our
we're running out of time.
Yeah. Our cross-platform coverage: radio, TV, YouTube, Bloomberg Originals. Folks, we will see you again tomorrow.
All right, coming up here on the big program, a deeper dive into the results that we got out of Zscaler and a nice preview of some of the software earnings on tap for this week. That's coming up next on The Close. This is Bloomberg. The broader market trading activity here on this Monday was somewhat tepid here, so I thought I'd take a look at some of the individual names. And in fact, one of the big winners coming out of Black Friday and Cyber Monday, it's a company that doesn't actually really sell anything at the retail level. It's a company that finances it. Buy now, pay later company, Affirm, rallying 12% here on the day. In fact, a lot of the companies in that space, including PayPal and a few others, doing very well here. The idea here that while holiday shopping and holiday spending might not live up to some of the expectations, the amount of money that these companies are going to make by financing some of those purchases should exceed those expectations. At the bottom of your screen, take a look at Albemarle, one of the biggest decliners in the S&P 500 today, as lithium prices continue to drop, largely because of the perception here that demand for EVs is going to continue to soften a bit heading into 2024. In the middle of your screen, two interesting stories. Salesforce, which reports earnings later this week here, a big focus this week on software companies, and FedEx, down 1.5% here on the day. And an interesting stat by our folks at Bloomberg, the biggest delivery company in the world right now is not UPS and is not FedEx, it's Amazon. As for the broader market today, not a whole lot to look at. Dow Transports were the biggest mover on the day, the biggest decliner too, I should point out, down 1.3%, and the VIX remains subdued, back below 13 here on the day. Meanwhile, the Treasury market was, well, somewhat subdued, but take a look at this chart here, and on the far end of your screen here, this is what everybody has been talking about and what a lot of people have been waiting for, and that's the total return on Treasuries to actually return to net positive on the year. It is now there, straddling the line between gains and losses, but a lot of bets, at least based on the CFTC data that we got from last week, seem to show that a lot of folks seem to think that we could see prices move materially higher before the end of the year. Scarlett?
Remember at the beginning of the year when everyone declared that this would be the year of the bond?
It's the month of the bond.
Well, yeah, well, maybe it's the month of the bond. All right, let's talk about housing because sales of new homes in the U.S. are down, falling 5.6% in October, due, of course, to high mortgage rates hurting demand. Joining us now for an indication of what this could mean is Danielle Hale. She is chief economist at Realtor.com. Danielle, what's interesting about the data is that it shows new home sales fell month over month across every region, but on a year-over-year basis, sales actually increased. What does that tell you?
That's right. It tells me that we're seeing different things in the new home market than we are in the existing home market. And while the existing home market is down and sales are close to lows not seen since all the way back in 2010, the new home market is actually faring quite a bit better. Despite this setback that we saw in the month of October, sales are actually on the higher end of where they've been over the last couple of years. And so in a market that's really starved for housing inventory, new home sales and new construction is a really important option for buyers who are ready to make a move and finding a hard time finding a home.
Yeah, new homes are also increasing as a share of total inventory. About roughly 1 in every 3 available homes is newly built as well. Now that the Fed appears to be willing to sit back and wait to see what's going to happen with interest rates and inflation, what does higher for longer but no longer rising interest rates mean for demand for new homes?
Yeah, I think it's a really interesting question. So there are a lot of people that probably have some pent-up demand in the housing market. But the question is, as mortgage rates turn and start to fall, sort of following those long-term Treasury rates down lower, and the Fed, also seems to be close to ending its tightening cycle, that'll propel long-term rates lower. What does that mean? Does that take away the sense of urgency that buyers have felt to really hurry up and get in the housing market and buy a home before rates tick higher? Or do they sort of lose that sense of urgency and feel like they have time to wait until the home that's right for them comes on the market? And so I think it's going to be an interesting year. The one thing I do think is going to be clear for the year ahead is that new home sales are likely to continue to provide a lot of options for buyers in the market, because I do expect, even though mortgage rates come down, that they will remain well above the rate that many homeowners have locked in on their mortgages. 90% of homeowners are under 6%. And so I think that lock-in effect is still going to be a really powerful effect in the months ahead.
So what does that sort of mean when we get to the traditional selling season, which typically takes place in the spring here in the U.S.? Does that mean we should expect, for those folks who are shopping, we should expect to see a lot less inventory?
You know, I think that's certainly going to be possible as we look ahead. Like I said, the lock-in effect is still going to be pretty important and pretty impactful, I think, as the market turns a corner into 2024. But a lot's going to depend not only on where mortgage rates are, but where people think they're going to go. A surprising number of consumers right now actually still expect that mortgage rates could go back up. But the longer we see them in this downward trend, I think the more people will begin to accept that the inflation is finally over. Mortgage rates have really turned the corner and are moving lower in a sustainable way. Because you might remember at about this time last year, we did see mortgage rates ease all the way from 7% back down to almost 6% in February, only to begin climbing again. I don't think we're likely to see that as we move into the year ahead. But the question is, what do consumers think about what's ahead for mortgage rates?
I do wonder if there is a sort of a breaking point. I mean, we were speaking with a guest earlier in the program about some of the geographic mobility, the idea that those folks who have the luxury of being able to move to a lower housing market have been actually taking advantage of that in a relatively meaningful way. But of course, that's still a very small subset of those folks who might be looking to buy a home.
Yeah, that's true. But a surprising number of people, even though they are a small subset, they make up a surprising share of the market. So we track cross-market shopping. So at Realtor.com, when someone is looking for a home in one market and they actually are residing in another market, we can identify that. And what we've seen is that even though that share was very elevated during the pandemic, not surprisingly, as people enjoyed flexibility, it has continued to be elevated, suggesting that the people who can afford to shop and navigate today's challenging housing market conditions continue to be those with flexibility. So they're an important part of the housing market and are likely to continue to drive sales.
What does demand look like from international buyers, Danielle?
So international buyers are generally a small portion of the overall housing market, just a couple of percent nationwide. Mm-hmm. But in certain markets, they can play an outsized role. So California, parts of Florida, major cities in the U.S. And so, as we move forward and get away from restricted mobility, I think we're likely to see that international buyer interest kind of tick up as we move forward.
I do have to ask you, though, about just kind of the general fee structure as well. That, of course, the big deal that, of course, with regards to the brokerage commissions and the shared commissions structure, if you will, that's obviously going to reshape a lot, just the cost structure, at least for one side of that equation. And I'm wondering if you are expecting material changes in the way that realtors, and for that matter, other real estate agents outside the realtor network, have to sort of price their services, and whether that has a material impact on what we see bought and sold.
I think that lawsuit, there's a verdict handed down. There are still challenges ongoing, but lots of lawsuits. So I think how it will ultimately shake out is going to depend on the ultimate decision by the courts, but also by the markets. And I think as long as real estate agents who are assisting buyers and sellers in transactions add value and make that value clear to consumers, I think they're going to be fine. I think the question is, how much value do consumers see in that interaction? And it is important, as people are making a purchase that is often the largest purchase they're ever going to make, to have professional representation so that they can understand what they're getting into and know the pros and cons of the process and what they're buying or selling, as the case may be. But I think the market is going to take some time to absorb all of this. In the meanwhile, consumers should be aware of the fact that commissions are negotiable. So I think that's an important point for anyone who's trying to buy or sell a home in the near term, as they're looking for a real estate agent, to make sure they have that conversation with their agent about how they're going to be compensated and how it's going to play out as part of the transaction.
All right, Danielle, I really appreciate you taking time for us. We're going to have to leave it there. Danielle Hale, she's the chief economist over at Realtor.com. All right, coming up, we're going to get some more insights on the results out of cybersecurity company Zscaler and what it says about the state of the sector. That conversation coming up next. This is Bloomberg. One of the big movers in after-hours trading is Zscaler, the cybersecurity company releasing its latest results. The company beating estimates, boosting its revenue guidance for the full year. But the shares, they're down 7% here in after-hours trading. Bloomberg Intelligence senior technology analyst Mandeep Singh joining us now to help explain. And I was going through the numbers here that Bloomberg put out here. We're talking about calculated billings up 30%, which was basically in line with estimates. Deferred revenue up almost 40%. And of course, we just mentioned they actually boosted guidance on one of the key metrics here. What gives with the share reaction?
Well, so I think when a stock runs up 25% in a month, which is what Zscaler has done, the expectations were high. And in this case, buy-side expectations were higher. In the print, I didn't see anything in terms of, what would drive the upside. Sometimes companies give you a conservative guidance, but they mention something in the release that tells you, OK, this is where the upside would come from. In the press release, you don't see that from an add-on product or something related to Gen AI, which is probably a reason for a slight disappointment.
They didn't mention Gen AI at all?
They did not, no.
Oh, wow.
That seems odd.
Yeah.
Why wouldn't you?
I didn't know that was a lot.
Or a co-pilot or a chatbot.
Yeah, you're a software company in this day and age. How can you not talk up the possibilities of AI?
Oh, probably it's going to come on the call. But look, Microsoft is a player in this space. They have launched a security co-pilot. So right now, everyone is kind of building their expectations around where is that lift from Gen AI going to come from. And for security companies, Copilot makes perfect sense. But for a pure play cybersecurity company that builds its own data centers, there is a big cost in building your own LLMs. And they haven't talked about the margin impact yet, but you have to ask yourself with Microsoft, they're going to get that lift from Azure in addition to Security Copilot. In the case of Zscaler, it's all going to that cost of revenue line.
Okay, so it raises uncomfortable questions that they'd rather not deal with, maybe.
Absolutely.
It's still a high growth company,
It is a high growth company. And I'm glad you mentioned the standalones because we get a lot of the other standalone cybersecurity companies reporting this week. Splunk, which eventually is not going to be standalone as they get absorbed by Cisco, Okta, and a few others as well. What are we expecting to hear out of them? Is it going to be a similar story?
I mean, right now there is a clear trend towards consolidation. Enterprise don't want to deal with 30, 35 security vendors. They want to deal with 5 to 7. And those are the platform plays which are going to emerge as the big winners in terms of sustaining their growth rates. CrowdStrike definitely seems to be one of them. So does Zscaler because they have been doing these tuck-in acquisitions and adding capabilities. Okta, on the other hand, had some struggles, with their systems getting breached, and that
a cybersecurity firm that got hacked.
Yes,
that's not good marketing.
That's not good marketing. So I think you really have to ask yourself in security which is a platform play because there isn't a cybersecurity company with over 10 billion in revenue, and that's why this space is hard because there are low barriers to entry when it comes to building a cybersecurity company.
So it's pretty fragmented. Palo Alto Networks, as you were telling us earlier, has been really on a buying spree. Who else is likely to be an acquirer here versus a target?
I would say CrowdStrike and Zscaler. These companies both
as targets.
No, as acquirers.
Okay.
I mean, because they are at a $2-3 billion run rate with a clear backlog to keep growing at 30-40% at least for the next 12 months, and they've got great balance sheets. Their stocks are much higher than everyone else, trading at 10-15 times sales. So they can do a deal, but the bar is higher in this market for any acquisition.
Okay, well, we'll see if that happens. I guess you got to have the cash or the stock, I guess, to do it. And I guess the question is also one about integration as well. Mandeep Singh, who covers all of this for us as Bloomberg Intelligence's senior technology analyst, a closer look at Zscaler, down 7% here in after hours trading. Of course, some of its peers scheduled to report over the next 2 days. Meanwhile, coming up here on The Close, Brian Bilski going to be stopping by the big program, Chief Investment Strategist at BMO Capital Markets. He's going to give us his outlook for 2024. That's coming up next on The Close. This is Bloomberg. Volume incredibly light here on this Monday, coming off the holiday shortened week. The net effect was a broader market relatively unchanged. Some interesting pockets of movement, though, particularly around some of the retail stocks, but also against some of the industrial stocks as well. In fact, the biggest laggard that we saw on the day was in the Dow transports. The other big action was in the Treasury space. Well, for once again, we finally actually seen the Treasury market, believe it or not, higher on a total return basis. On a year-to-date basis, I should say. It's been oscillating between gains and losses over the last few weeks and months here, but now an uptrend appears to be in the cards, at least for right now. A little bit later this week, we are going to get some economic data, and we are going to hear from Fed Chair Jerome Powell. In fact, the Federal Reserve has been on pause for the last 2 meetings, but some economists, they do see U.S. core inflation staying stubbornly high. Abigail Doolittle, she's standing by now with a little bit more.
And I think that this is really the debate that market watchers have been having for a long time, Romaine, and nobody really knows. But with the rally in stocks recently on that slightly cooler than expected CPI report for the month of November, some think that the Fed is on hold. However, to Romaine's point, there are economists out there that say that inflation could stay stubbornly high and that this is a reason to think that rates will stay stubbornly high. Let's take a look at PCE. This, of course, is the Fed's preferred way of looking at inflation. And I think that this puts it into perspective. Back in 2019, PCE year-over-year number was 1.5% and then about 1.6% or so. And then in 2021, spiking up to 5.2%. In 2022, 5.9%. At the high, 7%. Right now, we are at 3.7% or so. We have come down from that 7%, but yet it's much higher than pre-pandemic. So I think that the Federal Reserve, the point that Fed Chair Jay Powell has made in the past in terms of saying that they're not thinking about cutting, they want to see it really get closer to that 2% mandate. Here's another look at this. So what we're looking at here in white is CPI and blue PCE over time. And here again are the pre-pandemic very, very low. And then in yellow, we have the reds, the Feds, the upper bound of their target rate at 5.5%. So we do have inflation going in the right direction, but is it enough? Does the Fed need to stay higher for longer to make sure that the 1970s and the early 80s doesn't happen? They've sort of indicated that. As for risk assets, Romaine, let's take a quick look at the 10-year yield and the S&P 500. It's interesting because you can see back in 2022, when rates were really flying higher, the 10-year yield, it did cause that big downdraft for stocks. Now we've had stocks going higher with rates, but it's also interesting in this particular view that rates higher, staying higher, looks like a little bit like a ceiling for stocks, maybe some more volatility ahead for the S&P 500.
All right, Abigail, thank you for that great setup. For more insight on the markets and the outlook for 2024, let's welcome Brian Bilski. He is Chief Investment Strategist at BMO Capital Markets. Brian, the conventional wisdom, as Abigail was telling us, is higher for longer, yet you're fairly optimistic. So what is your tweet length outlook for what we have in store in 2024?
Looking for a soundbite, huh? Well, no, thanks so much for having us, by the way. It's so great to be back. I would say this. On the front page of my report, I talk about the yeah, but bears. What you just heard was the yeah, but bears. Yeah, but, interest rates are going to be way for longer, and we're going to have a recession. That's been going on for 4 years now. And so the definition of insanity is saying the same thing over and over again and expecting different results. And I think that this notion of macro investing, quant investing, formulaic investing has bullied markets for 20 to 25 years, really since the tech wreck. We are so focused on macro variables, we're missing the forest through the trees. In the United States, we have amazing companies and amazing consumers that have done great things with their balance sheets, both on the consumer side and from the corporate side. This higher for longer thing, how about more normal for longer? That's the title of my report this year, normal for longer. This 2024 is going to be year two of a normalization process that's going to last 3 to 5 years. What does normalization mean? High single digits to low double digit, both performance and earnings growth, valuations that are like 15 to 18 times, and a treasury yield that's going to be a tighter trading range. Now, remember, people forget, we like to poke fun of the stock market and say negative things about the stock market, but this is the second year in a row that we've had real rates of return negative in bonds for the first time in 40 years. So it shook those fixed income investors. I believe we're heading into a period where you can own both equities and bonds together, but in equities in particular, with respect to the US, I'd like to say everything in moderation. You don't have massively overweight things, not massively underweight, kind of own small, mid, and large together.
Everything in moderation, that doesn't really fit with what the big cap index looks like right now, the S&P 500 at all. So how do you propose achieving that?
So we see a broadening out. We're actually starting to see it from a fundamental perspective in terms of the dispersion of where earnings growth and valuation is, especially within the quote-unquote Magnificent Seven. But also in other big cap areas, we're starting to see a spreading out of that. That's kind of one thing in terms of their performance from a fundamental perspective. But if you go back and look at things like cash flow, free cash flow, in return on equity, in earnings discernment, meaning stability within small mid cap areas, this is my 34th year doing this. I've never seen small mid cap stocks look in such great fundamental condition, and they've been massively underperformed. They're massively underowned. Some of that sentiment and momentum because I got to own Apple, I got to own all these names. That's not to say sell your Apple and Microsoft. I think you own those as core names and then layer around them these other names that I think can do very well.
You've been doing this for 34 years. You only look like you've been doing it for 33.
Listen, I'm the I'm the Doogie Howser of Wall Street. When I do that, when I say that, sometimes some of the millennials, they have no clue what I'm talking about.
Well, they don't. And that's my frustration with the millennials as well. But I mean, put your experience to use here, because you've seen a wide variety of market cycles, and you've seen a wide variety of themes emerge, some that have proven to be very prescient, like, the internet stocks in the 90s, and a lot of others that kind of went the way of the dodo. We're kind of at that again, where all we're talking about these days are AI, or maybe weight loss drugs, and maybe there's the other thing, given it competition. Is there still a thematic trade out there that you would go after?
Yeah, I think there is. I think it's called fundamental investing, but I think it's called the Jackie Moon trade from Semi-Pro. Everybody love everybody. And what I mean by that is...
No millennial got that reference.
No millennial got that either.
That's all right.
But that's okay. Here's what I think is going on. I think because we are so incensed with trying to compare AI to the dot bomb thing, that means it's going to work. Okay, that means it's going to work. But it also, we're only focused on a few names in AI. You think about how AI is going to impact McDonald's. AI is going to impact healthcare companies, right? But I think that when you take a look at stocks going forward in technology, people forget that technology has become the most stable earner in the S&P 500 the last 20 years because the volatility has come out, and the other thing too, think about this, people talking about a bubble in the market. Can't have a bubble if we're not seeing any investment banking deals. There's been hardly any this year. And Wall Street's going one way and technology stocks doing another thing. When you get both of them together, meaning we're seeing a lot of deal flows, a lot of IPOs, a lot of mergers and acquisitions, we're nowhere near any kind of bubble in tech.
We're going to talk about IPOs in just a moment, but you also see financials breaking out, and we've heard this before, and they haven't broken out. What's going to be the catalyst for that? Is it going to be M&A? Because there's also a lot of talk that there needs to be consolidation, yet that's been slow to happen.
There does need to be consolidation. Some of the regulators need to loosen that up. If you're a parent and sometimes you have to overcorrect your children, the regulators have overcorrected financials. They have. I mean, if you take a look at the balance sheet strength of some of these and the cleanliness of their loan base, some of the regional banks are having a harder time competing with the money center banks because of the balance sheet size. And there's no doubt some of the regional banks got over their skis because they were trying to create revenue. Same thing happened in 2008, but at a very broader side of things. But what I think is going to end up happening is once you start to see more upside in financials, we should be buying financials now in terms of M&A activity, like they should be combining now. But that doesn't happen because you need to see higher valuations. People feel that they're not going to go down when they start going up. People buy things when they start going up. So I think some of the regionals are going to be in play next year, principally because they need to be able to compete from the scalable side of things with the Bank of Americas, with the JP Morgans, with the Citigroups.
All right, Brian, going to have to leave it there. Always great to talk to you. And
thanks so
glad
much.
you're stopping by here every time you're in New York. Brian Bilski, Chief Investment Strategist over
the Doogie
Howser Capital Markets.
Financial Markets.
The Doogie Howser of Financial Markets. And while he was speaking here, we did get a red headline crossing the Bloomberg terminal. Shein That's the fast fashion company out of China, said to have confidentially filed for an IPO here in the U.S. And that's where we want to turn our attention right now, because we are learning from a lot of different sources here that several companies now looking to come to the public markets. That includes Shein, that includes Kim Kardashian's Skims brand, and it potentially includes Reddit as well. Here to talk a little bit more about this is Amy Orr, who joins us, who covers this for us here at Bloomberg. And Amy, I don't know if you had a chance to see the Shein headline. We actually brought you on to talk about some other IPOs, and I guess it's a little serendipity that they would come to, that we would get that news right now. What's sort of fueling this? Is this kind of the window opening for some of these companies to come to public?
I certainly hope so. I guess like on the back of November's equity rally, everyone is hoping that next year is going to be so much better. Also because there's a long pipeline of IPOs, Shein, Reddit, and some other ones that we've been talking about, including Waystar, including Zeekr as well, the Chinese electric car vehicle maker. They have all been in the pipeline for quite some time, definitely for Reddit, who's been in the pipeline since 2021. Shein's more kind of probably closer.
Yeah. Well, I mean, I have to ask you, and we're putting some names up on the screen here, but I mean, there's a reason why some of those names have been in the pipeline for a while. It wasn't just about market conditions. There were a lot of questions here just about the viability of those businesses, and I do wonder about the quality of what we're getting right now.
Well, a lot of the bankers are talking about like when the IPO window really opens up is going to be the cream of the crop that is going to be the first to go, because they have profitability, they have the scale, they are the ones that can actually really test the markets. You don't want to test the market with a really weak company and then close the market. So that's what a lot of the really big ones are supposed to actually go in the first 2 quarters of the year. So that's why like the likes of Reddit, which is like rumored to be at least 15 billion, if not more, and Shein, which people are talking about over $60 billion.
These are high-profile household names that we're talking about here, but if they have a disappointing debut, that could close the door pretty quickly on IPOs. Does it make more sense for spin-offs to perhaps test the market first? I mean, Rubrik, which is a Microsoft-backed cloud and data security startup, or all these other companies that are, trying to mainstream and streamline their business model, looking to not get rid of, but cash in on some of their side businesses. Is that a better way to go forward?
There are pros and cons to spinning off. Definitely, it depends on what kind of spin-off and what kind of assets you're spinning off. We've seen Kenvue, which spun off from J&J earlier this year, and now people are looking back at it and saying, "Oh, that was a good spin-off." But at the end of the day, if you want to carve out your price asset, what's left behind? Yeah. And then, like, people are always kind of like judging between the two companies. Are you going to buy one and get out of the other, or are you going to not get into the spin-off in the very first beginning? So it's always a toss-up.
I am curious. We haven't mentioned at all the elephant in the room, which is the Kardashians. Skims. I mean, look, this is going to do well no matter what. I would think that just given their star power, given that they're all household names, this is going to be one of those stocks, whether for better or worse, everyone's going to be talking about.
Definitely, yeah. And not to mention the fact that we've just come off the Thanksgiving, Black Friday, and also Cyber Monday today. So and consumer spending has stayed really strong throughout, despite the fact that all the indicators are saying that it might be a kind of a slowdown, but then it seems like this is going to be one of the companies that is going to benefit from continued spending.
Stuff now too. I mean, we're just
I know the NFL people actually, yeah. Have you tried them?
I have not. Thank you, Amy. But I have not tried them yet. But I'll take your sartorial advice, Scarlett.
Kim's empire is clearly expanding. Amy, really appreciate your joining us today. Amy Orr, fantastic timing here, especially with the headline that Shein is considering going public or files confidentially for a U.S. IPO. All right, coming up, we're going to turn to the latest out of the Middle East. An extension to the truce in Gaza will last until Thursday as Congress resumes a push to get more aid to Israel. This is The Close on Bloomberg.
Rishi Sunak, the Prime Minister of the United Kingdom, sat down with Bloomberg for an interview where he condemned all forms of anti-Semitism. Sunak has been under pressure after sharing the stage. You see it right there with Elon Musk at the AI Safety Summit earlier this month. Musk, of course, has been under fire for amplifying what most people believe to be anti-Semitic content on his social media platform X. Let's take a listen to some of Sunak's comments when he was asked about this by Francine Lacqua.
I don't tend to get in the business of scrutinizing what every single person says who I've interacted with. Of course I abhor anti-Semitism. And as you said, we've been unequivocal from the start of this situation that that is not acceptable in our society. And we've been very firm about that. I've personally been very firm about that. It's very sad what is happening.
But are you condemning Elon Musk?
As I said, I condemn all anti-Semitism, right? It's not about any one particular personality. I condemn anti-Semitism in all its forms.
He has a voice. He has a big platform, Prime Minister.
And as I said, I condemn anti-Semitism in all its forms. It doesn't matter whether you're Elon Musk or you're someone on the street who's shouting abuse at someone who happens to be walking past you. That's wrong in all its forms. Anti-Semitism in all its forms is completely and utterly wrong. And we have strong laws in place here to tackle racial hatred. People are inciting it. Some of the scenes we've seen have been unacceptable. And the police know that they should be using the full force of their powers to bring those people to justice. That's what we've been very clear about. And that's what we will continue to do. And we've made sure that the Jewish community gets extra funding here to ensure their safety and security, and we will continue to do that.
Prime Minister, what kind of plan do you have for Gaza? When do you think the fighting will stop? And can the UK actually be involved in the peacekeeping role afterwards?
You know, we've been consistently clear during this awful tragedy that Israel does have a right to defend itself. It should do that in accordance with humanitarian law. And we've also consistently called for sustained humanitarian pauses where aid can get in, but also hostages can come out. And I'm glad that that is now happening. And I think all of us will have seen some of the scenes over the past day or two and found that very heartening. It's important that everyone honours the agreement and we can continue to see more progress. And we will be continuing to talk to all our partners in the region, whether that's the Americans, the Israelis, the Egyptians, the Qataris, to make sure that we can see this through.
Is the UK still for a two-state solution?
Always has been and will continue to be. And we need to redouble our efforts towards that. And that's something we've been very clear about. And I spoke to the Palestinian president when I visited the region specifically about this. The UK will do everything it can to help the Palestinian Authority. We do need to look to the future of Gaza post-Hamas and actually make sure that everyone in the region can look forward to a future where they can live lives of dignity and security and opportunity. That's the vision that I think all of us share, but we've got to redouble our efforts to bring that about.
The Prime Minister of the UK, Rishi Sunak, speaking to our Francine Lacqua. And of course, today, Israel and Hamas agreed to extend a ceasefire until Thursday morning, while the U.S. says Antony Blinken, the Secretary of State, will be visiting Israel, the West Bank, and Dubai this week. Let's go now to Washington and check in with Bloomberg's Kayleigh Lines in D.C. Kayleigh, can you tell us a little bit more about Antony Blinken's upcoming trip? This will be, I believe, his third visit to Israel since the Hamas conflict began?
Yeah, Scarlett, he has made a number of these trips, and of course, every time has carried a very similar message to Israel, which is that the U.S. continues to support them in their fight against Hamas. However, a very big and stern message of restraint also has been delivered, consideration of the humanitarian aspect here. Of course, it is humanitarian pauses that the U.S. has been pushing for some time, and we have seen underway between Israel and Hamas for about 4 days now. Of course, it was set to expire tomorrow morning in the early hours local time. Will now be extended 2 days, allow for the release of about 20 more hostages that were taken by Hamas and about 3 times that many Palestinian prisoners released by Israel. This 2-day extension, any extension of this brief ceasefire, was something the administration had been pushing for, not just to get hostages out, but importantly to get that humanitarian aid in. As the Hamas-led health ministry in Gaza has said, about 15,000 Palestinian civilians have died as a result of this conflict. I would just keep in mind, even if we are seeing a 2-day extension, bringing the ceasefire to about 6 days in total, Israeli Prime Minister Benjamin Netanyahu has said repeatedly that once this brief ceasefire is over, the fighting will resume and will continue until Hamas is eliminated.
I am curious, Kayleigh, about just some of the optics with the president of the United States making the decision not to go over to the COP summit, the climate change summit in Dubai. And at least the media narrative seemed to be that he wanted to deal with some of these issues going on right here with regards to Israel, Hamas, and the U.S. role in solving that issue.
Yeah, Romaine, certainly that is an aspect of the president's focus. I would keep in mind there's also a lot domestically that the president may have to at least be around to discuss. And a lot of it is tied to this conflict as well. He, of course, has made a supplemental funding request to Congress with billions, not just for Israel, but also aid to Ukraine. And Congress is coming back to Washington this week after a Thanksgiving break to try to take that up. There has been a lot of discord, if you will, as to how exactly that aid should move forward. There actually was a Democratic Senator, Chris Murphy of Connecticut, over the weekend calling for any further aid to Israel to be contingent upon compliance with international humanitarian law. There's, of course, Republicans who would like to see no more Ukraine funding going forward. So there's kind of a domestic issue that needs to be sorted out as well that does actually play a direct role into how the U.S. addresses this conflict and supports allies moving forward that the president is going to be keyed in on as well, Romaine.
Kaylee Lyons, she's coming up next here after our big program, Balance of Power, where they'll dive a little bit deeper into all of these issues. Meanwhile, stick with us here on The Close as we set you up for what markets will have their eye on tomorrow. This is Bloomberg. A relatively quiet day here in U.S. markets on this Monday, but that could change tomorrow. We get a lot more earnings, including from Hewlett-Packard Enterprises and a few others.
And this really is about enterprise spending and IT budgets and the outlook that these companies offer in terms of how much companies are willing to set aside to spend on tech.
Exactly. Intuit, Workday, Splunk, CrowdStrike, some of the names. We'll have full coverage of that tomorrow right here on Bloomberg. And we get some more economic data on the housing market.
Yeah, we got new home sales today. We get Case-Shiller Home Price Index. But no matter what data comes out, the housing market is frozen. It's not moving.
It's not moving, right. I mean, if you're going to pay, what, 7, maybe even 8% interest rate, and then, of course, all those folks sitting on those, like, great, sub 3% mortgages.
No one's doing anything.
No one's doing anything here. Believe it or not, I know you're a big fan of Fed Speak, Scarlett, too.
Well, I mean, we get 2 more speakers tomorrow. We get Waller, we get Goolsbee, and then it's all in the drumbeat to Jay Powell speaking on Friday. That's the big one.
Is that the warm-up act? Do you think they actually, like, sort of coordinate and sort of let out? It's like sort of the folks who open
I really want to get into the details of who decides when Fed speakers speak and what happens there.
Yeah, I think they're just kind of left to their own. And we were talking a little bit earlier about the Treasury auctions that we had today and kind of the mixed bag that they're kind of showing. We're going to get another one tomorrow.
Yeah, the 7-year auction is tomorrow. We got the 2-year and the 5-year today. They kind of canceled each other out. One kind of meh, the other one a little bit better. We'll see how it shapes up for the 7-year.
All right, a lot to go over tomorrow, so please join us then here on The Close. In the meantime, stick around. Balance of Power is coming up next here in the U.S. We'll be back tomorrow. This is Bloomberg.